So students, welcome back. So welcome to our next lecture of revision series. And in the initial first two lectures, we completed your equity valuation. And in the first lecture in equity valuation, we discussed that what are the different models of equity valuation, how are we going to value the equity shares. In the second lecture, we studied something about right issues and also buyback of shares. And then we did some basic questions of bond valuation. And now, my dear students, in this third lecture, we are going to continue further with the bond valuation part. So, without wasting any further time, let's start with this revision. But just one small instruction, as I always tell you, that when you are seeing this revision series, just don't see the videos. Rather, keep your notebooks and calcies handy, because this revision series is all about how should you develop the thought process even in the examination. When you get such kind of questions, what should be your approach towards the question? Every particular question in which there is something new, we are going to conceptually revise that as well. So wherever there is a need to solve the question, we'll be solving that. So I just want you all to do this along with me. When in certain questions, when I'm just revising, when I'm just going through the questions, wherever you feel the need, just pause the video and try to solve this on your own. Okay. So just do your preparations conceptually very, very, very strong. And I'll try to cover as many questions as possible. But of course, the questions in which there is slight deviation, we will be focusing on that very properly. Okay. So let's start now with your next question. And let us start now with question number 45. Okay. So this is basically a very easy question to start with. So your Messrs. Akfa Industries is planning to issue a debenture series on the following terms in which there is face value given to you, terms of maturity. We have yearly coupon rate, and as you guys can just check, the coupon rate for year 1 to year 4 is 9%, for year 5 to year 8 is 10%, and year 9 and year 10 is 14%. So there are different coupon rates, and also the current market rate on similar debentures is 15%. The company proposes to price the issue in such a manner that it can yield 16% compound rate of return to the investors. Of course, usually the company does this because the company knows that similar type of debentures are yielding 15% rate in the market. So basically, they will try to enhance the discounting factor in such a way that more and more investors will subscribe to it. So that is why they might keep the interest rate as 16%. So 16% is the yield. So that will become your discounting factor. And the company also proposes to redeem the debentures at 5% premium on maturity. So whatever is the redemption value, you add 5% premium to it, and that will give you your future cash flows. All these things we have to discount it, and then we have to bring it to your present value terms. Okay. So a fairly easy question. Now, if you just want to see the solution for this particular question, then it is solved here, where we have year 1 to year 4, the interest rate is 9, and then we are going to definitely take the annuity factor for the first 4 years, then the annuity factor for 5, 6, and 7, 5 to 8 years, the 9 and 10, and at the end of the 10th year, we are getting the redemption value. We discount it, we bring it to the present value terms, and that's how we are going to get the present value, which is 71.3. Okay. So if you want, you can just take a screenshot of the solution or something like that, and so that you can, it helps you in revision at a later time as well. Fine. Now let's continue further and do the next question. So just wanted to say that the type of questions which we have revised in your bond valuation when it comes to your coupon rates and yield is, so we did one, we used to always do questions where the coupon rate is fixed, okay, where the coupon rate is fixed, and your yield, your discounting factor, that is also fixed. Okay, so this is type 1 of the question, which is very commonly seen, where the coupon rate is fixed and also your expected yield is fixed. But then we have also done a question in which the coupon rate is fixed, okay, but the yield is floating. So in that particular case, for year 1 to year 4, there is a different yield. For year 4 to year 5, there's a different yield. Or on that matter, year 1, there is a different discounting factor. Year 2, there's a different discounting factor. So how do we convert, bring from future value to present value? So this is also a type of question which is possible. Then there is a question in which there is a possibility of different coupon rates. So there is a floating coupon rates, okay, and the yield is fixed. So this is the type of the question where you can see that in this particular question, there are different types of coupon rates for different tenures, but the yield at which the discounting is happening, that is nothing but fixed. But the most challenging question would be what? Where there is going to be floating coupon rates, and your yield is also going to be floating. Okay, so ideally we are not going to have any such type of questions, but just imagine a situation where there is different coupon rates for every year, and the yield at which we are discounting, that is also different for every year. So that is going to be most challenging, but we have the questions where we have done this as well as this particular part. Okay, so these are the types of questions on bonds which we can get it. Okay, we have to identify what is the coupon rate, what is the yield, and that will really help you to solve it in much better way. Continuing further now, after question number 45, let's do question number 46. On 31st of March 2013, the following information about bonds is available, where we have zero coupon bonds, we have treasury bill bonds, then we have 10.71% GOI bonds, then we have 10% GOI bonds, and everywhere the face value is given to you, maturity date is given, coupon rate is given to you, and coupon dates are given to you. You are required to calculate in the first part if a 10-year yield is 7.5% per annum. What is the price of a zero coupon bond which would fetch on 31st March 2013? What will be the annualized yield if the treasury bill is traded at 98,500? If 10.71% GUI 2023 bond having a yield to maturity of 8%, what price would it fetch on 1st of April after the coupon payment which has been made on 31st of March? And if suppose 10% GUI bond having YTM of 8%, what price would it fetch on 1st of April after the coupon payment which has been done on 31st of March? Okay. So basically why I'm revising this question is because these are the different types of bonds, and here there is a zero coupon bond which is getting covered. Also there is annualized coupon bonds, and then there is semi-annual coupon bonds as well. Okay, so all these things are getting covered here. So a good question to revise. We have zero coupon bond, okay, which is maturing on 31st March 23. So obviously in coupon rate and coupon dates, you will always see not applicable, okay, not available at all. Now, the first thing which you have to understand is for a zero coupon rate, for a zero coupon bond, what is your yield? Your yield is nothing but the benefit which you are going to derive at the time of redemption. Okay. So basically there is no interest applicable here. So whatever is the redemption value, okay, that is the only economic benefit which you are going to derive from this instrument. So where are we standing right now? They have told you that it's a 10-year yield, okay, which is 7.5%. And how much would it fetch on 31st March 2030? So from 1st of April to 31st of March 2023, we are not going to get any intermediate benefits, but the only economic benefits which will be derived, that will be on 31st March 2023 by the way of 10,000 rupees. So in this question, what we simply have to do is, we will estimate this 10,000, we will discount it, and we will bring it to the present value terms. Okay. So on that basis, we will be getting present value of the bond. So as you guys can just check, we can simply take this 10,000 and multiply that by the present value factor at the rate of 7.5% at the end of the 10th year, which will give you your present value today. Okay. Let me just check if we have the solution for this particular question. Yes. So on this basis, if you can come to know, we are going to have the present value of the bond, which is 4851.94. Now, in the second part of the question, what needs to be calculated? What will be the annualized yield if the treasury bill is traded at 98,500? Now, my dear students, the treasury bill is traded at 98,500. So this is the price of the bond. And now we have to calculate what is the yield. Okay. See, treasury bills actually can be coupon bearing also, and it can be without coupon bearing also. In this particular question, there is no coupon rates which is given to you. So the only yield which you will generate will be what? You are purchasing this bonds for 98,500, and at the time of redemption, it is 1 lakh rupees. So the difference amount is nothing but what you are going to earn. But we want annualized yield. Okay, so what is annualized yield? Let's say, for example, I have invested in an instrument for the period of 6 months, and I have generated a return of 5% for that period of 6 months. So what is my annualized yield? It will be 10%, because for the first 6 months it is 5%. So annualized it will be what? It will be nothing but 10%, right? So here also, the first thing what we have to do is we have to calculate the yield for the number of days in which we have done the investment, and then we can annualize it. Okay. So we have actually purchased this particular bonds for 98,500. Now this will be redeemed for 1 lakh. Okay. So basically the difference is nothing but 1,500. Okay. And we have invested at 98,500. So if you can just check the solution for this, we will come to know that 1 lakh minus 98,500 divided by 98,500 into 100. This will give you 1.52%. Okay. But this 1.52% is for the period of our investment. So what's your period for investment, my dear students? So that is nothing but from uh, 31st of March, I think, no, we had done the investments on what date? In this particular case, yeah. So maturity date is 20th of June 2013. Yeah, so we have done our investments on 31st of March and the maturity date is 20th of June. So how will you calculate the number of days? So in this particular case, now my dear students, we have to consider from 1st April to 30th April. So 30 days for April, then for May 31 days, and for June those 20 days. So that will eventually give you 81 days of time period. So this 1.52% is for 81 days. So for 365 days, it should be how much? So then you will come to know that if you cross multiply this, this will be nothing but 6.85% per annum. So fairly easy question. We just have to calculate your annualized yield. So annualized yield will be nothing but the benefit which you're going to get at the redemption upon your original investment multiplied that by 100. Okay. Now, in the third part of the question, there is a 10.71% GUI bond. Now, YTM is 8%. And what price would it fetch today? After the coupon payment on 31st March. Obviously, now we are talking about 1st of April. So, obviously, we have to consider the interest which will be received on 31st of March of the next year. So, if you have made the investment on 1st of April, then the next coupon or the next benefits which you are going to get will be 31st March 2014. Okay. So basically here they have just specified that even if this particular bracket would not have been given, we would always consider the payments which always receive at the end of the year. So if you make the investments today, we always receive the cash flows at the end of the year. Okay. Now we have the YTM available as 8%. So what will be the price today? So we have the coupon rate of 10.71%. So let's calculate in this particular case, we are making the investments on 1st of April 2013 onwards to 31st of March 23. And in this particular case, as you all can check, we will be having your face value of 100, redemption value, tenure is 10 years, and your YTM is 8%. So based on this, your answer will be finally 118 million. Continuing further, if a 10% GOI bond having a YTM of 8%, what price would it fetch on 1st of April after the coupon payment on 31st of March? So last coupon payment was 31st of March. Now coming back on 1st of April 2018 onwards. Now, sorry, 2013 onwards, but this particular bond is going to mature on 31st March 2018. So now your tenure will change. Okay. And here they have specifically mentioned that there is 31st March and September. So it's a semi-annual coupon rate based question. So what we need to do is first, we have to check that it is for the period of 5 years. So your 5 years automatically become 10 terms. How 5 years? From 1st April 2013 to when is it getting matured? In 2018. So that is why there will be 5 years tenure, which will be termed as 10%. And you know the three rules which we do when there is semi-annual. We actually multiply the years to 2 multiplied by 2 to get the tenure. Then coupon rate we are going to divide by 2 and so is the yield. And based on that, then we'll be getting the final actual price, which is 108.11. Okay. So in this particular question, we learned how to calculate your zero coupon, uh, bond, what is going to be the value today, then also at the same time, what is going to be the annualized yield. And in that particular matter, what is going to be your annual coupon rates, what will be the intrinsic value, and also for your semi-annual coupon rates. Now continuing further. Question number 47, this is also very easy. Here we are required to calculate what is the current value of his uncle's portfolio. So what we need to do is simply for every particular bond, we have to first find out its value and multiply that by the quantity. So what is the value of the portfolio? It's nothing but bucket of investments. So summation of all the value of its investments in it. So bond A, bond B, bond preference share C and preference share D. We have the numbers available. We have the annual coupon percentage. We have maturity and yield. So based on this, we can very simply calculate for each and every bond what is going to be the value. So bond A, as you can see, annual coupon rate is 9%, maturity is 3 years and yield is 12%. So on this basis, we can definitely find out what is the value of the bond multiplied by 10. So that will be bond A total value. For bond B also, same concept will be applicable. We'll be taking whatever is the present value, okay, and redemption value also at the same time, discounted, bring it to the present value terms. Preferential C and preferential D. Now both of them, the maturity years are not given to you. So it means it's irredeemable. It means it's perpetual in nature. So you can do this on your calci as it is. We have 11% annual coupon rate. So you can simply take 100 into 11%. that will give you a preference dividend of 11, which will be constant in perpetuity. So we can simply divide that by 13% to actually get what will be the value of the preference share today. Okay. Multiply that by our quantity. So that will give you a total value of the preference shares, and same goes for a preference shares D. So whenever we need to find out what is the value of these perpetual bonds, we can simply take their coupon rates, we can simply take their benefit which we are receiving and capitalize it. That will give you the final answer. Question number 48. Now, this question, I just want you all to solve this along with me, and slightly different, okay, which was originally there in your practice manual as well. So let us read first what the question is all about. Petfit PLC has outstanding a high yield bond with the following features, in which there is a face value of 10,000 pounds and a coupon rate is 10%, maturity period is 6 years, and special feature, company can extend the life of the bond to 12 years. Okay, so this is the special feature which this particular bond possesses, and that is the life of the bond can be enhanced to 12 years. Presently, the interest rate on equivalent bond is 8%, so this will now become your discounting factor. Also, at the same time, you all can just check that it is mentioned if an investor expects that the interest rate will be 8% 6 years from now, then how much you should pay for this bond now. And suppose on the basis of that expectation, if you invest in the bonds, but the interest rate turns out to be 12% 6 years from now, then what will be the potential loss or gain if the company extends the life of the bond for another 6 years? Okay. So this is a good question to revise. Now, what we are going to do in this particular question. See, basically what is happening is that a company has actually issued a bond whose face value is 10,000 pounds and the coupon rate is nothing but 10%, and these bonds are going to mature over the period of 6 years. Okay. There is a special feature. And what's the special feature of the bond? That after the end of 6th year, when we are going to redeem it, so redemption value will also be 10,000 because no other information is given to you. So when we want to redeem it, but if suppose the company wants, it can extend the life of the bond to another 6 years as well. Okay. But at presently, the company is issuing this particular bonds, which is offering a yield of how much? It is 8%. Okay, so presently the yield is 8%. Okay, so what is happening here is that right now the yield in the market which is going on is 8%. So company is issuing this particular bonds at a coupon rate of 10%. Thinking what? Okay, so let me issue it at 10%. Okay, and more and more people will subscribe to it. Okay, and at the end of the 6th year, then I will check what is going to be the yield in the market. Now, for example, the yield in the market, okay, after 6 years from now is, let's say, for example, 15%. Now, my dear students, what do you think that the company will do? Will the company redeem this particular bonds? Then the answer is absolutely no. Why? Because the company will think that I have actually raised money at 10% cost of capital because coupon rate is 10%. But at the end of the 6th year, the yield in the market is now 15%. Now, who wants to redeem bonds, at the end of the 6th year, when the bonds is just offering a 10% yield, okay, when the bonds is offering 10% coupon rate. So in this particular case, the company will enjoy this particular funds at 10% cost of capital. If suppose the company wants to raise more funds at the end of the 6th year, then it might have to raise it at 15%. So which company would want to, redeem bonds at the end of the 6th year, right? So they will consider the market conditions at the end of the 6th year. Suppose at the end of the 6th year, let's say for example, if suppose the yield in the market is going on as 15%, so people are investing, in the bonds which are offering 15% rate. It means if the company wants to raise the funds, it has to issue the bonds at 15% coupon rate. So right now we have issued at a cheaper rate, so will continue for another 6 years as well. Okay. But if suppose at the end of the 6th year, the company realizes that the yield in the market is just going on around at 5%. In this particular case, the company will think, yeah, why should I pay 10%, interest to my investors? Why should I have a higher coupon rate? Rather, what should I do? I should redeem this particular bonds. Okay. So there is an investor who is of the thought process that at the end of the 6th year, this bonds market will have a market yield of 8% only. So when the yield in the market continues to be 8% at the end of the 6th year, so investor thinks that now the company will not extend the life of the bond. Why the company will not extend the life of the bond? Because the company will think that, okay, why should I pay 2% extra coupon rate? Rather, I will redeem this particular bonds and then I will see, that if suppose the yield will fall, then I will further raise this particular bonds at a cheaper interest rate. So basically, when the investors expect that at the end of the 6 years, the bond continues to give a yield of 8%, 8%, 8%, the bond continues to give the yield of 8%. In that particular case, the investor will think that it's better, that the company will redeem this particular bond at the end of the 6 year, I'll get the money. But my dear students, what if it becomes more than 8%, more than 10%, and the company decides that they want to now extend the life. So investor now cannot go and redeem the bonds with the company. In that particular case, what the investor will do at the end of the 6th year, the investor will go and sell these bonds in the open market, right? Because the investor calculations gone wrong. Investors thought that KR at the end of the 6th year, anyway, the yield is going to be 8%. So company will not extend the life of the bond. So I will go with the company and redeem this bonds. But if the interest rate changes, it becomes more. The company has decided to extend the life. So investors can't redeem it. So what will the investors do? Then it has to rely on the market and sell the bonds in the market. So in the first part of the question, they have told you that if the investor continues, then what is going to be the impact? And in the second part, if in the first part, if the yield continues to be 8%, then what is going to be the impact? And in the second part, if the company extends the life, in that particular case, what is the potential gain or loss? Okay, so very quickly we'll do this particular question. But just to summarize this for you, we can just write down here, if yield continues at the rate of 8%, and here I will write down if yield increases. Okay, all this is at the end of 6th year. At the end of 6th year. Okay, now if yield continues to be 8%, then my dear students, can I say company will not extend the life of the bond? Okay, do you all agree with this? And if the yield increases, then what will we say? Company will extend life of bond. Okay, so here in this particular case, there is no other option but the redemption will be done. Okay, so company will redeem bonds. Okay, and in this particular case, can I say company will not redeem bonds? Will not redeem bonds. Okay, it means investor will sell bonds. Will sell bonds at the end of 6th year. At the end of 6th year. I hope you all agree with this. Okay, investor will sell the bonds at the end of the 6th year. Now, my dear students, if we continue this further, you will come to know that how much should the investors should pay for the bond right now. Okay, fine. So in the first part, we are required to just calculate what is the value of the bond today. Okay, so this is the timeline year 0, year 6. We have to find out what is going to be the intrinsic value or value of the bond today, where we have your redemption value as what's the redemption value? It's going to be pound 10,000. Okay, and we also have the coupon rate, which is nothing but 10%. Okay, so what will be the present value of the bond? So present value of the bond will be nothing but interest into PVAF, which is at the rate of 8% for how many number of years? For 6 years. And whatever is the redemption value, I will multiply that by the PV factor at the rate of 8% at the end of 6th year. Okay, now what is my interest element? So as you all can just check, it is 10,000 pounds and the coupon rate is 10%. So it is now going to be pound 1,000. Okay, and your redemption value continues to be now 10,000 pounds. Okay, so what is going to be now the present value? So 1 divided by 1.08, 1, 2, 3, 4, 5, 6. Oh, 1 second. I think coupon rate is 10%. Okay. So 1 divided by 1.08, 1, 2, 3, 4, 5, 6. So this will be 0.6302 and this will be now 4.6229. So which I multiplied that by 1,000. Okay. And I'll take 10,000 and multiply that by 0.6302. So this will eventually give me pound 10,925. Okay, so this is the present value of the pound of the bond today. Okay, so the first part of the question is now addressed. Now, what is given to you in the second? Now suppose on the basis of that expectation, he invests in the bond. So he is now going to pay 10,925. Okay, he has already paid this amount, but the interest rate turns out to be 12% 6 years from now. So of course, the life of the bond will now be extended. Then what will be the potential gain or loss? Okay. So in this particular case, in the second part, we need to find out what should be the price of the bond at the end of the sixth year. Okay. So in this particular case, suppose you are standing here, okay, and now you want to find out what is the value of the bond, what is price of the bond which you are going to get at the end of the sixth year. So let's say, for example, the person who's going to purchase the bond from you, how will we think? He will think that, okay, so I'm going to now invest in this bond, okay, for another 6 years, okay. So now for another 6 years, when I'm going to invest in this bond, I will be definitely getting pound 1,000, okay, and I will be getting the redemption value of 10,000 pounds. But what is important is the market yield. So what is the market yield? The market yield is now going to be 12%. So his expectation for another 6 years is going to be 12% for the period of how many number of years? For the period of 6 years, because now the extension of the life is for another 6 years. So that's why it's going to be for 6 years. And also, what is going to be the PV factor at the rate of 12% at end of sixth year? So will this data be sufficient for you to calculate the value? Come on, yes or no? Yes, sir. So this will now become 1 divided by 1.12, 1, 2, 3, 4, 5, 6. So this comes out to be 0.5066, and the total of this comes out to be 4.111. So that's why if we take pound 1,000 and multiplied by this and the redemption value of pound 10,000, and multiply this by the PV factor. So now I'll be getting finally, I hope you guys are solving this with me. Okay. So this will now give you finally, how much is this? Finally, this will be 9177. Okay. So 9177, this is the value of the bond. He is ready to pay. The opposite person is just ready to pay at the end of the sixth year pound 9177. Because he's not going to pay more, because now his expectation is now 12%, which is more than the coupon rate. So bond will be valued at discount only. So how much is your potential loss? So you had invested at what price? 10,925, and now you are selling it for what price? So it is pound 9177. So eventually you will realize that there is a loss of pound 1748. So this is the loss which the investor is going to face. Okay. So this was a very nice question. Your question number 48. Now let us start because the conversion parts will do it all together. Okay. So I'm just leaving it for the time being. And this is your question number 54. Okay. So in question number 54, there is only one small thing, that is what is the number of days which will be required to meet the break-even transaction cost. Okay, so this is just slightly new in the question. Let us read first what the question is all about. That Mr. X wants to invest rupees 1 lakh in the 7 years 8% bonds in the market where the face value is 100 and which were issued 2 years ago. You are requested to advise him what is the maximum price of the bond in the following scenarios. So basically, guys, this is extremely simple. That if the rate is 9%, what is going to be the value of the bond? And if it's 7%, 8.25%, and 7.75%. Okay. So these are nothing but different types of yields on the basis of which we have to calculate the value of the bond. Okay. Now, at the same time, uh, let's say for example, if I get the solution for this, I'll just show you, so that becomes easier for you. For this particular question. So this one is actually your question number 54, right? So as you guys can just check, in this particular question, you will have the face value is 100, the coupon rate is 8%, life is 5 years, and the redemption value is also 100. So what is going to be the uh, price of the bond? So it's 96.1, 104.1, 99.0 and 101 based on the calculations what you're going to do here. So at these yields, you just have to discount it and we have to bring it to the present value term. So fairly easy. In the second part, if the bonds are available at par and 1% is the transaction cost, what is the effective yield? So we are required to calculate your yield to maturity. Okay. When the bonds are available at par, it means 100 rupees, but there is 1% transaction cost. So which makes your purchase price as 101. So the only thing what we have to do is in the YTM calculation, when we take into consideration your redemption value minus whatever is your purchase price, which we divide by n, matlab interest plus RV minus PP upon n and divide that by RV plus PP upon 2. So here the purchase price will now become 101. Why? Because there is a transaction cost. So we have to add it, right? So this is something which you just have to understand. Actual B0 is 100 and we are going to have 1 rupees as your uh, transaction cost. So total it will now become 101. So this is how we calculate the YTM approx formula where we have the interest, then we have the redemption value minus purchase price and we calculate it accordingly. We'll be getting 7.76%. Now in the third part, what is given to find the number of days to the break-even cost if the bonds are available at par and 2% is the transaction. So now if suppose the face value is 100 rupees and 2% is the transaction cost, so 2 rupees is nothing but your actual brokerage cost. So how much number of days will be required to recover that 2 days, that 2%? So it's very easy because we are receiving a coupon of 8%. So 8% on 100 is 8 rupees. So 8 rupees is for 365 days. So for 2 rupees, it's how much? So you'll simply cross multiply it and you will come to know that you will be having a total of 92 days or approximately 3 months you can try. So that is nothing but your transaction cost recovery that will be done in your 92 days. Okay. Question number 55, you have to calculate your zero coupon bond and also your 12% gilt bonds. So 12% gilt bonds is nothing but your coupon bearing bond only. So how are we going to calculate the value of the bond? So that is something which they have given to you. So that's a very easy question to solve. Okay, now question number 56. In this particular question, I'll need your attention. What is given to you? XYZ has raised 50 crores through an issue of 9% bond. Each bond has a face value of rupees 500 and 10% and 10 years to maturity. As per the terms of the issue, each bond is redeemable in 4 equal installments starting from the end of the 7th year. You are required to find out the price of the bond if the YTM is 13% and at what is the current yield. Now, in this particular case, obviously, my dear students, when we are required to find out the value of the bond today, how? So we always take future value of cash flows, we discount it, we bring it to the present value terms. In this particular question, my dear students, we are not going to take your a formula for the purpose of calculation of the value of the bond. That is because the redemption happens in 4 equal installments. So here we have to compulsory prepare one table which will help you to understand what is going to be the series of the cash flows. So as you all can just check, okay, for this particular question, we have year 1 to year 10, okay, and of course the first redemption is happening at the end of the 7th year. So usually how do we calculate the value of the bond? We simply take interest, we multiply that by the PVF, we add the redemption value, multiply that by the discounting factor, we'll be getting the present value. But in this particular question, the redemption is happening in installments. So for year 1 to year 7, obviously the interest will be at a constant rate. Then what is going to happen is that the first cash flows will be received by the investors at the end of the 7th year. So that is 500 divided by 4. So 125 will be receiving it. So that's 170. That will be the cash flows received. Now, in the end of the 8th year, the interest which will be calculated, that will be definitely on your balance amount which is left with the company. So from 500, 125 is going to go away. So then on 375 rupees, whatever is the coupon rate given to you, you'll apply that 9% and then you'll be getting the final interest amount. So every year the interest will be diminishing because of the company redeeming the bonds at the end of every year. We discount it and then we'll get the present value, which is 401.12. Okay, so this is about your question number 56. Now question number 57, here what is happening is the same concept, but here we are having 2 installments on the basis of which the discounting is happening, on the basis of which the redemption is happening, that is at the end of the 5th year and at the end of the 6th year. Okay. In this particular case, it's a semi-annual bond. So here the timeline will automatically change. What was supposed to be discounted at the end of the 5th year will, what was supposed to be redeemed at the end of the 5th year will now be redeemed at the end of the 10th term. Similarly, what we redeemed at the end of the 6th year will now be redeemed at the end of the 12th term. So that's how we are required to calculate from the future value to the present value. So what are you going to do? We'll be preparing the entire table in which we'll be having 12 terms in all. So the same thing which is applicable, your coupon rate will now become 5%. But the only thing is that the effective tax rate of Texas is 40%. Now, this statement will definitely have no impact in your calculations. Why is that so? Because you always remember like this, my dear students, that whenever we are calculating the YTM, in this particular case, we are required to calculate the YTM. So we have to actually prepare this by using the concept of IRR, because I cannot use YTM formula here. Redemption is not happening once. See, if the redemption happens only at one particular point of time, then I can definitely calculate YTM approx by taking interest plus RV minus purchase price upon N. But here the redemption itself is happening in different installments. So I cannot use that particular formula. So what I need to do is we have to just simply take whatever is your, we have to prepare the table, whatever is the IRR concept, we have to do that. And based on that, we are required to calculate the YTM of the bond. Okay. So you're simply using the concept of IRR, we'll be getting the final answer. For question number 57, always ignore, in this particular case, the tax rate given by the company. Why? Because when calculating YTM, we only calculate post-tax YTM based on what concept? That when the investor is liable to pay the tax. Okay. But if the investor is not liable to pay the tax, now investor is liable to pay the tax under what situations, under which situations, that it is possible that whenever the interest is given to you, you have to convert from pre-tax to post-tax. So that is when we take that into consideration. Also, when the redemption value is available, that also at the time of getting the redemption money, there is a capital gain tax. So then we have to calculate on post-tax rate. But whenever the company's tax rate is given to you, we simply ignore it. Okay. So that's how, on the basis of your IRR, we will be calculating what is going to be question number 57, YTM. Okay. Question number 58. Now, in this particular question, Woodco issue 1 crore bonds of rupees 1,000 each in the market on 1st of April 97 at par with a maturity of 31st March 2007. Okay. So on 1st of April 97 to 31st March 2007, we have a good tenure of 10 years. Okay. Face value of the bond is 1,000 each, and these bonds carry a coupon rate of 14%. Okay, which are payable on half yearly basis. So immediately what comes to your mind is going to be everything on semi-annual basis. Three things will be applicable. This should be your thought process. Then you are required to calculate what is the YTM on the date of the issue. These are redeemed at par. Now this first part is very easy because we don't have to do any calculations here. What is the YTM on the date of the issue? So we are required to calculate the YTM. How will we calculate the YTM, beta? It's very simple. We have your coupon rate of 14%. Okay, and the bonds are issued at par. Okay, it's mentioned here. It's issued at par. The redemption happens at par, right? So just 1 second. So here the bonds are actually issued at par. They are redeemed at par. So of course your YTM is nothing but your coupon rate. Okay, so the first part does not require any calculation at all. Your YTM itself is your coupon rate. In the second part, the market value per bond as on 1st of April 2002, if the interest rate prevailing in the economy is 11%. So now, my dear students, if the yield prevailing in the economy is 11%, and that is also on what date? On 1st of April 2002. So understand a situation where an investor is standing, the bonds were issued on 1st April 97, but the investor is standing on 1st April 2002. The bond will be matured on 31st of March 2007. So ultimately now there is 5 years left, which is nothing but your 10 terms. Okay, and we are required to calculate what should be the value of the bond if the interest rate prevailing in the economy is 11%. So here we have to calculate the market value of the bond. So how will we do this? Interest into annuity factor plus redemption value into the PV factor. Your interest, because it is on semi-annual basis, that's why it will become 70, that is 1,000 into 7%. So that is going to be 70, and the redemption value will continue to be 1,000. And your yield will become 5.5%. So based on that, you will be getting the value of the bond on 1st of April 2002. Now, if these bonds are purchased at price calculated in the second above, what is the current yield? So how will you calculate the current yield? Whatever is the interest, we divide that by the actual price of the bond, which is derived in the second part. So we'll simply divide it, we'll be getting the current yield. if the market price on 1st of April 2002 is 950, then what is the YTM on that date? So if the purchase price of the bond on 1st of April 2002 becomes 950, so what is going to be the YTM? So again, for YTM, we can use YTM approx formula where we can take the interest, we can add whatever is the redemption value minus purchase price upon N, the whole divide that by redemption value plus purchase price upon 2 into 100. So here, my dear students, the interest is now going to be what? From 1000, you multiply that by 7%, that will be 70. And your tenure is now going to be for 10 terms, okay, because we are starting on 1st April 2002. The purchase price will be 950 and rest all the other things same. And based on this, you can calculate what is going to be the YTM. In the E part, if the call price on 1st of April 2002 is 1100, then what is the yield to call on that date of the issue? On the date of the issue. Now, this is something which you have to understand. We are required to calculate what is the yield to call. Now, see, what is happening here is that these particular bonds are actually going to be called on 1st of April 2002. So we are standing on what date? We are standing on 1st of April 2097, and the bonds will be called upon on 1st of April 2002, okay, and it is going to be matured on 31st of March 2007. So earlier the entire tenure was for 10 years, okay, but now the tenure will automatically become for 5 years. Why? Because we are calling the bonds on this particular date. Now, when we are calling it before its maturity, so what happens is that we have to decide the call price. At what price am I going to redeem this particular bonds? So my call price here is already mentioned, which is nothing but how much? It's 1100. So my call price is 1100. So I'll be redeeming this particular bond at 1100. So what is going to be the price of the bond on 1st of April 97? What is going to be the yield to maturity? So see, what is going to happen here is we are going to subscribe to the bonds on 1st of April 97 and the bonds are actually issued at par. So that is why 1000 rupees is going to be your uh, purchase price, and it will be redeemed not at the redemption value but at the call price, which is going to be 1100. Okay, we also have the interest, and the interest rate is given to you as 14%, but we're going to take 7% on semi-annual basis, and based on this we are required to calculate YTC. Okay, so your yield to call will be nothing but interest plus redemption value minus purchase price upon N, and divide that by redemption value plus purchase price upon 2. I would just like to make one small correction here. Instead of redemption value, we'll write out call price. Okay. And that's how we'll be calculating your yield to call. Fine. Chalo. So this is how your question number 58 will also be calculated. Fairly easy question to solve. Now, question number 59. This question also requires your attention. An investor purchased at par a bond with a face value of 1000. Fine. So an investor has invested 1000. The bond had 5 years to maturity and a coupon rate which was given to you, that was 10%. Okay, so far so good. The bond was called 2 years later for a price of rupees 1200. Oh my god. So what has happened is that the bond was actually called at the end of the second year. Now, my dear students, when the bond is actually called at the end of the second year, it means that the investor is going to receive the 1200 rupees back. Okay, and the call price is 1200, so he's going to get 1200 rupees, and that is after making the second hand interest payment. So interest is also paid and the bond has been called for. Now he then reinvested the proceeds in a bond which is selling at a face value of 1000 with 3 years to maturity. So with that 1200 rupees which he received, what did he do? He has reinvested it. Where he has reinvested it? In another bond which is having a face value of 1000. So can I put it like this, that because he has reinvested his proceeds in a bond, so bond is having a face value of 1000 and he got 1200 rupees at the end of the second year. So he is reinvesting the proceeds. So he is reinvesting 1200 rupees. So can I say is per se buying 1.2 bonds. Okay, he's buying 1.2 bonds. So when the interest will be received for the remaining 3 years, that is at the end of the third year, fourth year and fifth year, can I say that interest will be calculated on 1200 rupees? That is his amount of the investment. So we have to be very, very, very careful here while we are calculating what is going to be the interest element. Okay, so just make sure that he reinvested the proceeds in a bond. So when he is reinvesting the proceeds, it means that he is reinvesting his 1200 rupees. So when he is reinvesting the 1200 rupees, my dear students, the interest which will be available to him will be on 1200 rupees at the rate of your 7%. So your students make maximum mistake. They calculate the interest for the remaining 3 years on 1000 rupees only. But that's not the case, because we have to see that what is the amount of investments what you are making. And that's how the total returns which is getting generated. Okay. And the bond is selling at a face value of 1,000 with 3 years to maturity. Coupon rate is 7%. What is its YTM for the period of 5 years? Okay. Now see, let me explain to you like this. Year 1, 2, 3, 4, 5. We are going to get interest. We are going to get redemption value. So for the first 2 years, we have invested 1,000 rupees. We are getting a coupon rate of 10%. So I got 100. I got 100. Okay. And then what is happening is that the company is calling for the bonds at 1,200 rupees. Okay, fine. So I got this 1,200 rupees, but immediately what did I do with this 1,200 rupees? I have reinvested. So then in that particular case, 100 rupees is going to be my cash flows at the end of the second. Now in the third year, when we are calculating the interest, will that interest be calculated on 1,000 rupees at the rate of 7%? Then the answer is no. Why? Because in the first year you invested 1,000 rupees, you invested one bond. So you were getting automatically 100 rupees on the same. That was your yield. But now in the third year, your investments in another bond is 1.2 bonds, because they have invested the proceeds. Had they said that only 1,000 rupees is being invested and 200 rupees is invested somewhere else, then the things would have been different. But here we are investing the entire proceeds. So interest will be actually available on that 1,200 rupees. So that's why on 1,200 rupees at the rate of 7%, 84 is going to be the yield. Again, at the end of the fourth year, 84 will be the yield. At the end of the fifth year, 84 will be the yield. And then we'll be redeeming the bonds at rupees 1,200 rupees. So we'll be getting 1,200 rupees back. So this will be 1,284. So can I say 100, 100, 84, 84 and 1,284? Will this be your series of cash flows? Yes or no? Yes, sir. And this is something which we're going to discount it at what percentage rate? Okay, so we actually have to calculate your YTM. What is required to be calculated, beta? We are required to calculate the YTM over the period of 5 years. Okay, so we have to calculate the YTM in such a way that the present value becomes 1,000. So we can create a range in which we can have one discounting factor, of 10%, and you can take another discounting factor of 15% and then check that where this 1,000 rupees is getting generated. But here my basic objective was to teach you what should be the series of cash flows. Okay. If you're not able to digest, okay, sir, how can we invest 1.2 bonds? So understand like this, that an investor was actually, they had purchased, let's say, 5 bonds at the beginning of year 1. Okay. So at year 0, they had purchased 5 bonds. So when they had purchased 5 bonds, can I say 5 into 1,000? 5,000 rupees was nothing but their outflow. But then what is happening? At the end of the second year, they are receiving 5 bonds into 1,200. That is going to be 6,000. So 6,000 rupees will be received. Now this 6,000, they are going to invest it entirely in another bond with a face value of 1,000. So can I say now they will end up buying 6 bonds? Okay, they will end up buying 6 bonds. But the yield will be calculated on entire 6,000. So on 6,000, then we need to multiply that whatever is going to be your returns, which will be at the rate of, I think, what was it? 12%, 7%. So then 7% will be calculated accordingly. So 6,000 ka 7%. Okay. And that will be nothing but 420. And we decided that there were how many number of bonds which we have invested? We have invested 6 bonds. So based on that, then we can calculate it and do it accordingly. But you can take that in totality also, or else if you want, you can take this individually as well. And that is how we are going to do the calculations. Okay, fine. So if this solution is also available, I'll just present that to you. Okay, fine. So this is the solution for it, and the discounting factors somewhere between 10 and 12% you're going to get it. So finally your YTM, sorry, it's between 12 and 15%. So you can also take 10 and 15% and do it accordingly, or 12 or 15%. Eventually you'll be getting 12.3%. That will be your final answer. Okay. So this is going to be your solution to question number 59. Now, my dear students, let us start with your question number 60. Okay. So let's start with your 60th question. A bond is held for a period of 45 days and the current discount yield is nothing but 6%. It is expected that the current yield will increase by 200 basis point and the current market price will fall down by 2.5 rupees 2.5. We are required to calculate what is going to be the face value of the bond and what is going to be the bond equivalent yield. So we are required to calculate two things: face value and the bond equivalent. Okay, so how are we going to approach this particular question? So here, uh, let's say for example, if my bond, which is the current discount rate is 6%, okay, and the yield is expected to increase by 200 basis points. So let me put it like this. Earlier it was 6%, but now it is going to increase it to 8%. Okay. 200 basis point, as you all are aware that 100 basis point is 1%. So for 200 basis point, it's going to be 2%. And because the yield increases, you know, the price and interest inverse relationship. If the yield increases by 2%, then automatically what will happen is that the price of the bond will come down by rupees 2.5. So if yield increases by 2%, then the price of the bond will fall by rupees 2.5. Okay, so now basically this is 2% increase is on per annum basis, but we are actually holding the bond for 45 days. Okay, so the impact also needs to be calculated accordingly. So you know what will I do is, let's say for example the 6% is for 360 days. So for 45 days it's how much? So let me first calculate what is the equivalent percentage. So 45 into 6, divide that by 360. So this will give you 0.75%. So can I say the bond is offering actually a yield of 0.75%? Okay, so this is the bond is offering a yield of 0.75%. Now, if suppose it is expected that after we purchase the bond, the yield is going to be increased by 200 basis points. So now what is going to happen is the yield will become 8%. So 8% yield is for 360 days. So for 45 days, the yield is going to be how much? So we are now going to take 45 into 8, divide that by 360. So now it's going to be 1%. Okay. So a scenario appears in front of you where you are right now investing in the bond. Okay. You are right now investing in a bond thinking that the yield offered is 6%. Okay. But suddenly what is happening is that the yield is increasing to 8%. So because of that, the price of the bond is falling by rupees 2.5. So can I say that 0.25% increase for 45 days is actually reducing the price of the bond by 2 rupees 2.5. So then in this particular case, we are required to calculate what the face value of the bond. So how will you calculate the face value of the bond? You'll simply take whatever is the reduction and capitalize that by 0.25%. So we'll divide that by 0.25% because that's the percentage increase because of which the price of the bond is falling by 2.5. So you simply take 2.5 and divide that by 0.25%. Eventually, you'll be getting the face value of the bond, which is 1,000. Okay. And then they have told you uh, this is the face value of the bond and what is bond equivalent yield. So we are required to calculate the yield of the bond. Now, in this particular case, is there any coupon rate, etc., which is provided to you? Then the answer is no. So how will you calculate the bond equivalent yield? Now see, it's very easy. Actually, your bond equivalent yield will be nothing but very close to 6% only. Why? Because what is the yield for a particular bond? A yield for a bond is nothing but we take interest plus RV minus purchase price upon and we divide that by RV plus purchase price upon 200. So that should come to your mind when we are calculating the yield. But in this particular case, we don't have the coupon rates at all. So that is why the yield generated or the return generated by an investor is nothing but the outcome of the capital appreciation. At the price he's going to buy the bond and at the price at which it's going to be matured. So the difference is nothing but the yield. Okay. So when I'm buying the bond right now, what is the market yield which is going on? It's going to on as 6%. But this 6% is on per annum basis. So what is the equivalent yield which I will take it into consideration? So that's going to be 0.75% because for me, the investment is only to be done for 45 days. Okay. Now, in this particular case, what is going to be your investment amount today? So I need to take 1 divide by 1. Now, see, my discounting factor is 0.75%. Huh? So this will be 1 plus 0.0075. Okay. So this is going to be my discounting factor, right? To calculate the yield. So if I take 1 divide by 1.0075, so I'll be getting somewhere around 0.992. Okay. And if I multiply this by 100, by 1000 rupees, sorry, which is the face value of the bond. So right now the price of the bond is 992.56. Okay. So it's something like this. I have purchased this bond for 992.56. It's getting redeemed for 1000. So the only difference is nothing but the yield or the returns which I have generated. So that is nothing but 7.44. So 7.44 is the returns which I have generated on 992.56. Multiply that by 100, right? So this will eventually give me same 0.075. So 0.75. So this 0.75 is for 45 days. So for 360 days, the bond yield is how much? You will be finally getting this as 6%. So obviously, my dear students, when we are purchasing the bonds, at today at a 6% yield. Okay, so obviously we are purchasing the bonds for 992.56. Now, if you are holding it till the maturity, which is 1,000 rupees, so the difference is nothing but the appreciation which you are earning, that is 7.44. So the yield itself is going to be 6% per annum only. So there is no need to calculate the same by common sense. Also, we know it's 6%. But yes, here there is a different outlook as well. If we take, the full figures available, then the answer will be somewhere around 6.01 or 6.02, something like that. But ideally, the yield is nothing but this particular rate itself, which is at the rate of 6%. Okay, because see, I convert that future value into present value at 6% rate, and now on the base of that amount, if I make the investments and hold it till maturity, obviously in the yield which is going to be generated, that has to be 6%. Okay, so I don't know why institute had framed this particular question and asked, because the answer here is going to be 6% itself. And also, when 8% yield will be given to you, obviously the answer for that is going to be similarly 8%. So there is no value addition to this particular question. Okay. So let's get started now with question number 61. Now, question number 61 explains you this concept that the reinvestment actually happens at the discounting factor itself. Okay. Now, this is something which is very important. As in IRR, we had understood that the cash flows which are getting generated, that are reinvested at the IRR rate. So here also, when we are calculating YTM, or whenever we are calculating the actual price of the bond, then whatever is your interest which is getting generated, all those things get reinvested at that yield rate itself, at that IRR rate itself. And on that basis, we get what is the present value. So compounding impact takes into consideration when we are calculating the present value of the bond. Okay. So what do I mean by this? Okay, first, let us read this question. An investor acquired at par a bond for rupees 1,000 that offered a 15% coupon rate. Okay. At the time of the purchase, the bond had 6 years to had 4 years to maturity. Assuming the annual interest payments, calculate the actual YTM if all the interest payments were reinvested at an earning of 18% per year. Okay. Now, if they were reinvested at 18% per year, we always say that face value of the bond is 1,000, redemption is at 1,000, bond has a life of 4 years, coupon rate is 15%. It means that the YTM itself is 15%. So we always assume that the reinvestment actually happens at 15% rate itself. Okay. But they have told you no. If suppose all these particular reinvestments happen at 18%, then what is going to be the answer for it? Okay. So what do I mean by this? Just pay attention. See, in your question number 61, I'll do one extra part to just make you understand that reinvestments actually happen at its own YTM only. Okay. So what do I mean by this is, let's say for example, we have here 1, 2, 3, 4. Okay. We have here 1, 2, 3, 4. Okay. And we also have the interest as well as the redemption. Suppose your face value is 1,000 rupees, okay, and we are earning at the rate of 15%. So your interest is 150, 150, 150, 150 plus redemption value of 1,000. So this will become 1150. Okay. Now, always remember that if the bonds are traded at par, redemption is at par. So of course your YTM will be equal to your coupon rate. Okay. So ideally your discounting factor is also 15%. So the price of the bond which will come here, this has to be 1,000 rupees. Okay. So if I calculate this, 1 divided by 1.15. Okay. So this is 0.86952. If I multiply that by 150, then I will take 1 divided by 1.15. You all can also do this along with me. The second PV factor is 0.756. If I multiply that by 150, so that will be 113. 1 divided by 1.15. Again, your third year PV factor is 0.657. I multiply that by 150. And in the fourth year, 1 divided by 1.15. 1, 2, 3, 4. I need to multiply that by 1150. And ultimately, the total of this will be give you 1,000. Okay. So here what happens is, we follow the principle that this interest that gets reinvested at 15% for the remaining 3 years. Okay. Why do I say this reinvestment happens at the rate of 15% for the remaining 3 years? Is because 150 is received at the end of 1 year, So the remaining life is 3 years. So we assume that these cash flows are reinvested at the rate of 150 for 15% for 3 years. Okay. So what happens is the future cash flows, okay, which will be calculated is 150 will be reinvested at the rate of 15% for 3 years. Okay. So what is going to be the future cash flows here? So 1.15 square cube, multiply that by 150. So this will now give you 228.13. So basically 228.13. So this 150 reinvested for 3 years at the rate of 15% will give you 228.13. This 150, okay, 1.15 square. Now this 150 will be received, but this can be reinvested only for the remaining 2 years. Okay. So now I'll be taking 1.15 square and multiply that by 150. So this will ideally give me 198.375. Then my dear students, this 150 can be reinvested only for the period of 1 year. So that is why I will take 150 and multiply that by 1.15. So this will now be 172.5. And in the last case, this will now be your 1150, and this cannot be reinvested. Why? Because ultimately this is something which is going to be received at the end of the 4th year itself. Okay. So this will be 1150 itself, and the total year is coming for me as 1749. Okay. Now, my dear students, this is called as my terminal value, okay, which is going to be received at the end of the 4th year. Understand, like this, you make the fixed deposits today, okay, and tell them that this is my 1000 rupees fixed deposit. Your rate of interest is 15%, okay, but whatever interest you are going to give me, reinvested at the rate of 15%. Can I say at the end of the 4th year, when the FD will mature, you are going to get 1749. So this is your terminal value. So you are going to get 1749 at the end of the 4th year. Okay. So this is the amount on termination. Now, my dear students, amount is nothing but principal into 1 plus I raised to the power n, right? Suppose 1749 I will be receiving at the end of the 4th year. Okay. Let us check what is the total yield which you have generated from this entire investments. So 1749 I'll be receiving at the end of the 4th year. My principal is 1000 rupees. Okay. Into 1 plus I raised to the power 4. So what is going to be now your yield which will be generated? So 1749 divided by 1000. This will be 1.7490 is equal to 1 plus I raised to the power 4. So if we take the root 2 times, so now ultimately this will be 1.15 is equal to 1 plus I. So your I is nothing but 15%. So did you realize that the yield which is getting generated, the returns which is getting generated from this entire investments, that is nothing but 15%, which was your YTM itself. It was nothing but 15%, which means that the reinvestment happens at the YTM rate. Okay. So always remember like this, that YTM or IRR is based on the fundamental that whatever intermediate cash flows which you are receiving, that is reinvested at the same YTM rate. Okay, at the same rate it's getting reinvested. That is how you are going to actually, based on this assumption, the entire YTM is based. Okay, but if someone tells you that we are not reinvesting this at 15%, we are going to reinvesting this at 18%. Now, if we reinvest this at 18%, then don't you think this terminal value of the cash flows will be higher? And if the terminal value of the cash flows will be higher, then your yield which will be generated, that is going to be greater than the coupon rate. Come on, yes or no? Yes, that will be more than 15% rate. And if suppose they tell you that we are not going to reinvest it, and if we are going to spend it immediately, so in this particular case, it's not going to grow at a compounding rate. Rather, this future value of the cash flows will continue to be 150, 150, 150, and 1150. So in those situations, the actual yield which will be generated, can I say that is going to be less than the 15% rate? So now I have explained you all the three situations. Situation number one, when reinvestments happen at the same rate, can I say that the YTM will be nothing but the coupon rate itself? But if suppose the reinvestments happen at a rate which is higher than the coupon rate, in that particular case, the yield generated will also be higher. Come on, yes or no? Yes, sir. And if suppose the reinvestments happen at a rate which is lower than coupon rate, or it doesn't happen at all, then in that particular case, the yield generated will be less than the coupon rate. Okay. So this is something which I wanted you all to understand first. Okay. See, in this particular question, see, let's say if the reinvestment is happening at the rate of 18%, Can I say all these cash flows, 150, 150, 150 and 1150, that will be reinvested at the rate of 18%. And based on this, we'll be getting the answer as 1782.31. So this is 1782.31. The principal is 1001 plus I raised to the power 4. And based on that, we'll be getting the yield as 15.54%. Okay, which is greater than 15%, as we were discussing. And if suppose the reinvestment is happening at zero rate, then can I say this is the total 600, 1600 which you'll be getting. So based on this, this will be 12.47%, and that is going to be lower than your 15%. Okay. So I've already explained you all these three situations. I hope you have understood this particular question. Okay, because this clarifies that in this particular case, the yield keeps on generating, reinvestments at the rate of 15% itself. Question number 62. Okay. Okay. Now in question number 62, we are actually required to calculate what is going to be the spread. So this is again a very easy question. Okay. Quite manageable. A hypothetical company ABC issued actually 10% debentures, face value is 1000, of the duration 10 years and is currently traded at rupees 850 per debenture. The bond is convertible into 50 equity shares being currently quoted at rupees 70 per share. If the yield on equivalent comparable bond is 11.8%, calculate the spread of the yield of the above bond from this comparable bond, and the relevant present value tables are given. Okay. So first of all, we are required to calculate what is going to be the spread of the yield on the above bond from the comparable bond. So first of all, spread is nothing but the difference between bond YTM versus the yield as per the market. So what is the yield as per the market? 11.8%. So first we need to calculate what is the bond YTM. So once we get the bond YTM, we come to know what is the spread of the bond. Okay, so if suppose the bond is offering you 15% YTM and people are expecting in the market just 11.8%, then can I say the difference is nothing but the spread, okay, which this particular bond is offering. So based on the question, we got to know that the YTM is coming as 12.3%, okay. And here, if we convert that, then we get the spread, which is nothing but 0.63%, okay. So we can also do it like this, where we can discount it at, we can calculate the YTM like this as well, where it is coming as 12.76%. So if we do it on IRR method basis, then we'll be taking the range of 11 and 13% and solve it accordingly, or 10 and 15%. Based on that, there will be slight difference. So it will be 12.76%. So then the spread becomes 0.96. So always remember that when they ask you to calculate spread, what is spread? Whatever is the yield which is going on in the market and whatever is the bonds YTM, the difference between the two is called as a spread. Okay, great. So now with this, your question number 62 is also done. Now, so your bond valuation, all the major questions are done. Now I will teach you something regarding your conversion premium. Okay. So we are just left with revision of all these conversion premium questions, which we'll do it together. Okay. See, concept of conversion premium. So all these questions now we'll revise it together. So what happens when we are talking about conversion premium? See guys, this concept is applicable for the fixed income securities, which has an option for conversion into another instrument, and mostly your equity shares. Okay. So let's say, for example, debentures, bonds, preference shares, if those are going to be converted into equity shares in some number of years, then how the concept of conversion premium is going to come. Okay. See, let's say, for example, if I tell you that, let's say, for example, if I tell you that the bonds, okay, bonds are right now available in the market, let's say for example at 110 rupees. Okay, so bonds are available in the market for 110 rupees, and the face value of the bond is rupees 100. Okay, and let's say for example the coupon rate is nothing but 10%. Okay, and the life of the bond is 5 years. Great. And these bonds can be converted into equity shares. Okay, these bonds can be converted into equity shares, and it can be converted into equity shares that one bond can be converted into 5 equity shares, and the market price of one equity share right now is, let's say for example, 18 rupees. Okay, it's 18 rupees. So basically, if you are standing right now today, okay, if you're standing right now today, and if someone wants to buy equity shares, then can I say those equity shares are available right now at 18 rupees. Okay, So if you are buying 5 equity shares, if you are buying 5 equity shares, then can I put it like this? 18 into 5 is nothing but 90 rupees. You have to pay 90 rupees right now. Come on, yes or no? Yes, sir. But instead of that, if you opt for bonds, and if you tell that no, I want to buy bonds, then can I say you have to pay 110 rupees? Okay. So if suppose you are an investor, and if you have two choices, that let me buy equity shares, then you have to share it from your pocket 90 rupees. But if you tell me, okay, no sir, let us buy bonds, okay, then you have to shell it from your pocket 110 rupees. Now in this particular case, can I say you are paying some premium when you are investing in the bonds? Come on, yes or no? Yes, you are paying some premiums. Why? Because see, ultimately, if the bonds gets converted into equity shares, at and for one bond you're going to get 5 shares, then you're just going to get 90 rupees. But if suppose you are just buying equity shares, you have to pay 90 rupees. So bond, if suppose it's traded in the market at 110 rupees, are you paying some premium? Are you paying some premium when you are buying these bonds? Come on, yes or no? Yes. How much premium are you paying? You are paying 20 rupees more. You are paying 20 rupees more. Why do you think that an investor pays 20 rupees more when they are buying this particular bonds? Rather, they should only go for equity shares, because equity shares is ultimately 90 rupees. And here you are buying fixed income security where you are actually paying 110 rupees. You are paying 20 rupees more. So why does an investor pay those kind of premiums? So they pay premiums. Why? Because investor thinks that first of all, these particular equity shares, they are not going to give any dividends. Or let's say if they give the dividend is let's say 2 rupees, 3 rupees. Okay. But if suppose they are buying these particular bonds, then these bonds going to provide you with a fixed interest, which is at the rate of 10%. So 10 rupees they are going to get fixed interest over the period of 5 years. Now, if suppose these particular shares are very much fluctuating for the period of 5 years, it's better that we invest in the bonds and get interest every year. And at the end of the fifth year, whatever the price of the bonds will become, if suppose we are going to, convert after the end of the 5 years, so we are definitely going to earn more. And over the period of 5 years, we have also earned some interest on the same. So that's why investors are ready to pay some premium in these kind of bonds as well. Okay. So first of all, what is your conversion value? So your conversion value is nothing but, can I say, number of equity shares on conversion, multiply that by the market price per share. So that will give you your conversion value. So every bond has a conversion value. Every fixed income security has a conversion value. We just have to check that what are the number of bonds it's getting converted into equity shares, and we'll multiply that by the market price. So we'll be getting a conversion. What is conversion premium then? Actual market price of the bond minus conversion value. So as I told you in this particular case, 20 rupees is nothing but my conversion premium. Okay. Then what is your percentage of downside risk? Now, what do I mean by downside risk? Downside risk means when there is a possibility that the bond price can fall. That is called as your downside risk. Now, let's say intrinsic value of the bond is just 95 rupees. So it's not necessary now that the bonds are always traded at this intrinsic value. Suppose intrinsic value of the bond is 95 rupees. But my dear students, the bonds are traded at 110. So don't you think that in those situations, there is going to be some kind of a risk that from 110, it can fall to 95. So that is why the percentage of downside risk is nothing but whatever is the actual market price of the bond. From that, we subtract the intrinsic value, divide that by actual market price of the bond into 100. So that gives you percentage of downside risk. Then what is the conversion parity price? Conversion parity price is nothing but actual. Now, what is conversion parity price? So parity price means at what price equity share should be traded at to be at par with the bond. So as you all can check that the price of the bond is 110 and it is going to be converted into 5 equity shares. So 110, if I divide that by 5, 110, if I divide that by 5, what will I get is rupees 22. So as per conversion parity price, one equity share should actually be traded at 22 rupees in the market. So that is what your conversion parity price tells you. Okay. Actual market price, divide that by number of equity shares on conversion. Now, what is your favorable income differential? Now, favorable income differential means that if you have invested in the bonds, we are going to get interest. And if you would have invested in equity shares, we would have got some dividends. So let's say, for example, the bond is offering you an interest of 10%. So can I say 10 rupees is the interest which you are going to get? And if suppose if you would have invested in equity shares, you would have got some dividends. So let's say for example, your dividend per share would have been example 1.5 rupees. So 1.5 rupees multiplied by 5 equity shares. So that will give you a total of 7.5. Okay. So ultimately, can I say 10 minus 7.5? 2.5 is the differential income which you're earning. So if you would have purchased 5 equity shares, you would have got a dividend income of 7.5. But if you would have, purchased one bond, you would have got an interest of 10 rupees. So is there a favorable income differential? Yes. 2.5 is something which you are going to earn extra. On how many number of, if I calculate that on per share basis, so if I divide that by 5, so 2.5, if I divide that by 5, I'll be getting 0.5. So 0.5 is nothing but the favorable income differential per share basis. Okay. So that is how we calculate on per share basis. If they don't ask you per share, then it's okay. We can simply just write down 2.5. That is our final answer. What is your premium payback period? Now, this is something very interesting because see, if you are actually paying some premium for the bonds, you're also getting some extra income, right? So you guys can just check that here we are actually getting extra income of 2.5. We are getting an extra income of 2.5 and we are paying how much extra? We are paying 20 rupees extra. So 20 rupees extra we are paying. How did I get this extra part? If I would have purchased equity shares, only 90 rupees would have gone from my pocket. But now if I am purchasing bonds from my pocket, 110 rupees is going. So is 20 rupees extra going? Come on, yes or no? Yes, sir. 20 rupees is extra going. This 20 rupees, if I divide that by every year, I'm getting 2.5 extra by the way of differential income. So 20 divided by 2.5 will ultimately give me 8 years. So it will take 8 years for me to recover that extra premium which I'm paying. Are you understanding? So this is called as, premium payback period. That extra premium which you have paid, how many years will it take? So I'm getting 2.5 as my differential income every year. So 20 divided by 2.5, 8 years. That will be the tenure. Okay. So I hope you all have understood this much part as well. Now, my dear students, with the help of all these things, now we'll be calculating, we'll be doing some questions on your conversion premium. So you'll find it easy. 49th. Okay. So let's do this 49th question. The data given below relates to a convertible bond where we have the face value of the bond of rupees 250. We have the coupon rate of 12%. We have number of shares per bond which is 20. We have market price which is 12 rupees. And then we have the straight value of the bond. So straight value is nothing but the intrinsic value of the bond. And also what the market price of the bond. Okay. So all these things. First part is what is the stock value of the bond? So stock value of the bond is also called as conversion value. So as you guys can just check, number of shares per bond is 12 and we have the market price of the bond of the share which is 12 rupees. So that's how we'll be getting number of equity shares into market price of the bond, that is nothing but 240. So that will be your conversion value. What is the percentage of downside risk? So when it comes to your downside risk, always remember that we have to see what is the intrinsic value and what is the price of the bond. Okay, so the same thing. So the price of the bond is nothing but 265. Straight value is 235. So from your 265, if I subtract 235, divide that by 235, divide that by the actual market price of 265 into 100, that will give you the percentage of downside risk. Okay, here there is one more option available. If you want, you can also divide that by the intrinsic value as well. It depends upon you. Okay. So we will follow, this actual price of the bond will divide it. We'll be getting 11.32%. What is the conversion premium? So what is the price of the bond? It's 265 rupees and the conversion value is 240. So are we paying something extra, 25 rupees? Yes or no? Yes, sir. And what is the conversion parity price of the bond? So the price of the bond is 265 and there are 20 bonds which are traded in the market. So simply 13.25, that will be treated as your conversion parity price. Okay. So this is how we'll be solving the question. Now continuing further, we will solve one question in which there is, we'll revise that in which there is all these things. So we will do question number 52. Okay, because 52 covers all these things. If you know 52, then all the other questions you'll be able to do it very, very, very easy. Okay, so let's revise this question number 52. The following data is related to 8.5% convertible bonds, okay, into equity shares, and the debentures issued by JSC at rupees 1000. So your face value is 1000 and the market price of the debenture is now 900 rupees. Conversion ratio is 30 and the straight value of the debenture is 700. So that's your intrinsic value. Market price of the equity share on the date of conversion is 25 and the expected dividend is 1. So what is the conversion value of the debenture? So how will you calculate your conversion value? You will simply take the number of equity shares which you are going to get and multiply that by whatever is your market price of an equity share. So which turns out to be 25. And based on this, if you calculate, you will be getting what is your number of equity shares 30 and the market price per share is 25. So this will be nothing but 750 rupees. So this is your conversion value of the debentures. Then your B part. What is the market conversion price? So we can simply take market price of the bond and divide that by number of equity shares. So this is your parity price. Market conversion price is also known as parity price. So at what price the equity share should be traded at? So you will simply take 900, divide that by 30. So you'll be getting 30 rupees. That will be nothing but your parity price. Then what's your C part? What is the conversion premium per share? So what's your conversion premium? Market price per debenture is 900 rupees and your conversion value is 750 rupees. So from 900, if I subtract 750, 150 is called as the premium because obviously conversion value is 750. We are paying something extra. We are paying 900 rupees. So that is why this is the premium and per share basis. You divide it, you'll be getting it as 5 rupees per share. Then what is the ratio of conversion premium? Now, what is this ratio of conversion premium? So, whatever is the premium on per share basis, okay, we simply divide that by market price per share. So, we are paying a premium of 5 rupees per share more and the market price per share is 25 rupees. So, how much percentage in terms of percentage? So, conversion premium, if I want to calculate in percentage terms, how will I do that? So, what is the premium per share? Simply divide that by market price per share. So, that is called as ratio of conversion premium. What is the straight value of the bond? So simply take the difference between the two. Premium over straight value of the bond. Also, we can call this as the percentage of downside risk. But here we are just, because it's over the straight value of the bond, we will divide that by the intrinsic value and ultimately get this as 28.57%. And what is the favorable income differential per share? So as I told you that if you're investing in bonds, you're going to get the interest, that is 85 rupees. If you would have invested in equity shares, you would have got 1 rupee into 30. So 30 rupees is your equity. The difference between the two is your 55 rupees. So this is extra, which you are going to get if you are going to invest in your bonds. And if I calculate this on per share basis, so I'll divide that by 30, I'll be getting 1.83. And what is the premium payback period? So you simply take your premium per share and divide that by favorable income. So 5 rupees extra premium you are paying and you are going to get 1.833. Exactly what I've explained to you here. The same thing. Okay. So how much premium you are paying, divide that by, how much is the favorable income. So here also you take the premium and divide that by your favorable income, you'll be getting 2.72 years. So if you know all these things, then all the other questions of your conversion premium gets covered very easily. Okay. So now I'm not worried much about your conversion premium part, but now we are going to start with your duration and your modified duration. So इस particular concept में duration and modified duration में पहले आइए समझते हैं कि duration का basic meaning क्या होता है. See guys, जब भी हम लोग बात करते हैं कूपन बेरिंग बॉन्ड्स का, so कूपन बेरिंग बॉन्ड्स में क्या आपको इंटरेस्ट मिलते रहता है? कम ऑन, यस और नो? ऑफ कोर्स यस, आपको इंटरेस्ट मिलते रहता है, राइट? सो कूपन बेरिंग बॉन्ड्स में यू आर गोइंग टू गेट योर अमाउंट ऑफ इंटरेस्ट एवरी ईयर. तो अगर मान लीजिए आपने वो बॉन्ड परचेज किया है, लेट्स से फॉर एग्जांपल एट 100 रुपीज, ओके, आपने बॉन्ड परचेज किया है 100 रुपए में और आपको हर साल, सपोज मेच्योरिटी उसका 5 इयर्स है, बट आपको हर साल बीच में इंटरेस्ट पेमेंट मिलते जा रहा है एंड एट द एंड ऑफ द बॉन्ड ड्यूरेशन, एट द एंड ऑफ द बॉन्ड टेन्योर आपको रिडेम्पशन वैल्यू भी मिलेगा. ओके, नाउ इन दिस पर्टिकुलर केस, नाउ अंडरस्टैंड दिस कंसेप्ट वेरी थॉरली, that whenever in case of duration, if every year you are going to get some interest payments, okay, if every year you are going to get some interest payments and towards the end you are going to get your redemption value. So now we need to check that in how many number of years your actual investment will be recovered. Okay, so whenever I'm talking about duration, we are talking about the time period in which your actual market price of the bond will be recovered. Okay, so whenever someone will tell you, chalo, let us calculate duration of the bond, what are you focusing on? The time period in which your actual market price of the bond will be recovered. Okay, So suppose you have invested in the bond for 100 rupees. Life of the bond is 5 years. Redemption is going to happen at 100 rupees. Okay. And every year you are going to receive some 10% interest. Now, in this particular case, what will be the duration of the bond? Is it going to be 5 years? It will be more than 5 years or less than 5 years? Of course, less than 5 years. Okay. Why? Because less than 5 years is nothing but the time period in which whatever you have invested, that is something which is going to be recovered because you are going to get interest every year. So, my dear students, very simple concept that whenever we are going to deal with your duration, always think from the perspective that duration of the bond is nothing but the time period in which the investment starts getting recovered. Time period in which your investment starts getting recovered. Okay. Now, we always want the duration to be lower the better, because lower the duration, what does it represent? It represents that the amount which is getting recovered, that is as fast as possible. Come on, yes or no? Yes, sir. Okay. Now just check this out. Duration, okay, is the period in which bonds need to be held to recover the targeted cash flows from the bond. Okay. So basically, if I have purchased the bond for rupees 90, then if the bond is going to have a 7-year maturity, but every year I'm going to receive some interest payments. So of course, this 90 rupees will be recovered somewhere before 7 years. Let's say, for example, 5.5 years. So 5.5 years will be called as a duration of the bond. Okay. So duration of the bond in case of a coupon bearing bond will always be less than maturity. But whenever it is your zero coupon bonds, whenever it is your zero coupon bonds, can I say the duration of the bond will be nothing but its maturity? Why do I say that the duration is nothing but the maturity? Because suppose on maturity for a zero coupon bond, whatever money you are going to receive, you are going to receive that on maturity only. So 100 rupees is the bond. Okay. Suppose you have purchased for 40 rupees also, but there is nothing which will be received somewhere in between. So for a zero coupon bond, the amount which you are going to receive, that is itself in the maturity. So its duration will also be nothing but its maturity date. So what is actually a duration? It reflects the time period in which your investment is recovered. For zero coupon bond, there is no intermediate payment. So your investments will be recovered towards the maturity part only. So that's why its duration is equal to maturity. But for a coupon bearing bond, can I say that the duration will be nothing but less than its maturity? Come on, yes or no? Yes, sir. Okay. So in other words, it represents the time within which the bonds repays the coupon and the principal to the investor. Duration of a coupon bearing bond is less than its life, while the duration of a zero coupon bond will be equal to its life. This is also referred to as Macaulay duration. Okay, so exactly what we have discussed, and this duration concept is derived by Macaulay. And what is Macaulay tells you that if you want to calculate duration, we have to use bit of weighted average concept. Okay, so what does it mean? That let's say, for example, there is year 1, 2, 3, 4, 5. And suppose we are having interest of 10 rupees, 10 rupees, 10 rupees, 10 rupees, 10. And on the redemption, you are going to get example 110. So total is 120. Okay. So what we need to do is we have to discount it, and first we have to bring it to the present. Suppose your discounting factor is 10%. Okay. So 1 divided by 1.1. So 0.9091. Then this will become 0.8264. Then this will become 0.7513. This becomes 0.6830. And this becomes 0.6209. Okay. So what is the present value? So the present value will be 10 into 0.9091. So suppose this is your 9.091. Okay. So I'll simply do it like this. 1 divided by 1.1, 1, 2, 3, 4, 5, which I'll multiply, which I'll take this as present value annuity factor. Okay, but let me do this separately only because we will need that for the purpose of weights. So so your 10 multiplied by 0.8264. So this will now be 8.264. Okay. Then we'll be having 10 into 0.7513. So this will be 7.513. 10 into 0.6830. So this will now be 6.83. And then 125 multiplied by 6.209. So this will now be 74.508. So the total of this will now become 106.206. So this is the actual price of the bond. So in case of duration, what do we do is we discount it at your YTM, your yield to maturity. So we get the present value of the bond. Once we have got the present value of the bond, the next step is, what? That we have to actually calculate the weights of it. Okay. We have to calculate the weights of this present value. And because as per Macaulay, duration is nothing but the weighted average duration. So these weights I need to multiply it by years to actually get what is going to be the weighted average duration for the bond. So now what will be the weights here? The weights will be nothing but these present values. We have to take the weights of this. So what is the present value of the bond? 9.091. Divide that by 106.206. Okay. So this will give you 0.085. Okay. For example, this is the weight. Okay. Then my dear students, okay, what is going to be the next weights? 8.264. If I divide it by this 106, then this will be 0.078. Then if I take 7.513 and if I divide this by 106.206, then this will be 0.0707. Then 6.83, if I divide it by 106.206, this will be 0.0643. 74.508, if I divide it by this, so I'll be getting 0.7015. Okay. What is going to be now your weighted average duration? So 0.085 into 1. So this will be 0.085. 0.078 into 2. So this will now be 0.156. Then 0.0707. If I multiply it by 3, I'll be getting 0.2121. 0.0643. If I multiply it by 4, I'll be getting this as 0.2572. And then if I take 0.707015, if I multiply this by 5, I'll be getting 3.5075. And the total of this comes as 4.2178. So what is 4.272178? This is called as the duration of the bond. And as I just now told you, that the duration of the bond is always less than its maturity. So the maturity is 5 years. So automatically your duration of the bond will become how much? It will become less than 5. So it's 4.217. This indicates the time period in which you have recovered your 106.206. Okay. Lower the duration, obviously lower the risk, because we are going to receive more our money as fast as possible. But there is one more shortcut method to calculate the duration, which we called it as a product method. So guys, what do we do it in a product method? We take into consideration whatever is your year and we multiply that by the present value. So in product method, what do we do is we take year 1, 2, 3, 4, 5. We have present value. Okay. We have present value, guys. Which is nothing but 9.091, 9.091, then it is 8.264, then it is 7.513, then it is 6.83, and guys, the last one is your 74.508. Okay. Now, in your product method, what do we do is we take the product instead of taking the weights. We will take the product of present value into years. Okay, we'll take this particular product. So we'll take 9.091 into 1. So that itself is the same 9.091. We'll take 8.264, which will multiply it by 2. So that is 16.528. Then we'll take 7.513 into 3. So that will be nothing but 22.54. Then we'll take 6.83 into your 4. So that will give you 27.32. And we'll take 74.508 into 5. So this will be 372.54. So this overall will give you 448.02. So is this your product? Come on, yes or no? Yes. So what we need to do is this product, now we have to divide that by the actual B0. And the actual B0 was 106.206. 106.206. So what is going to be your now duration? So for duration, we will simply take summation of present value into year and divide that by the actual B0. So this was nothing but 448.02, which I'll divide by 106.206. So this will now be 4.21 years, 4.22 years. Just check, this is exactly the same, 4.21, 4.21. So my dear students, duration can be calculated by two ways. So first, Macaulay discovered duration with the help of weighted average method. So we took your years and then we took whatever was your weights, we multiplied that, we got the weighted average duration. And the other method is what? That we can take into consideration whatever is your duration, which will be present value into years, and divide that by the actual B0. So this is how we'll be calculating the duration of the particular bond. Okay. So product method is also possible, weighted average is also possible. So what are we going to do in the examination? So we'll be doing this particular product method in the examination, okay, for the purpose of determining the duration, okay. Then my dear students, what is the modified duration? So modified duration is also known as your volatility. And what do we do in this particular case? We'll be simply taking the duration and we'll be dividing that by 1 plus YTM. So your duration is 4.21 and divide that by 1 plus YTM. What's your YTM rate? Your YTM rate is nothing but 10%. So 1 divided by, let's say, 0.1. So 4.21 divide that by 1.1. So this will now give you your 3.83. So this is called as your modified duration, which is also known as volatility. And do you know, guys, what is the significance of this particular duration, modified duration? That if suppose your interest rate, if your interest rate reduces by 1%, then guys, the price of the bond, then the price of the bond will increase by 3.83%. So this is what your uh, you know, modified duration or the volatility of the bond will signify. So for your volatility of the bond, what we need to take is simple. We have to take your interest rate and the price of the bond. If the interest rate falls by 1%, then the price of the bond will rise by 3.83%. If the interest rate increases by 1%, then the price of the bond will fall by 3.83%. So the significance of volatility or modified duration is to check what is going to be the impact on the price of the bond for every 1% change in your interest rate. If it increases, then the price of the bond will fall. If it will reduce, then the price of the bond will increase. But how do you calculate now the modified duration in case of semi-annual coupon rate? So for semi-annual coupon rates, what we need to do is whatever is your 1 plus YTM, we simply divide that by 2. So that is how we calculate your duration for your modified duration for your semi-annual, okay, coupon rate payments. So whatever duration you have got, you will simply take 1 plus YTM, divide that by 2. So that's how we'll be getting for semi-annual part. Okay. So one question I will revise it for your duration as well. Okay. So let us do now your duration of the bond. I hope you guys have understood this very thoroughly. How do we calculate the duration? Okay. And modify duration as well. Now let's continue this further. Okay. So let's start with your question number. I want to do one question in which all these things gets covered. Okay. First, I want you to understand this question number 67. It's a little bit lengthy question, but in this particular question, you will understand that how the price of the bond is determined and which component has more element, which particular price of the bond will have more element of interest and more element of price of the bond. Okay. See, this is something which is very important for you to understand the concept of principal default risk and interest rate risk. Okay. Now see, what do I mean by this? Uh, every particular bond, my dear students, is subject to some risk. Okay. So there are two main types of risk when we are talking about bonds. The first type of the risk is called as principal default risk. Now, what is principal default risk? You go to the particular company for the purpose of redemption of the bond, but the company refrains from redemption. The company tells you, no, sorry, we are not going to give you the money. Okay. So redemption is not going to happen. So can I say that is nothing but principal default risk? Okay. So in case of principal default risk, what happens is that we are not going to get your redemption value. Okay. What is your interest rate risk? Your interest rate risk is when the market interest rate changes, the price of the bonds gets affected due to your changes in the interest rates. So that will be called as your interest rate risk. Okay. Now let's say, for example, uh, it's a 2-year bond. Okay. If it's a 2-year bond, okay, then in this particular case, when you're buying this 2 years bond, it means that this bond is going to be maturing after the period of 2 years. So which risk will be more in this particular type of bond? So then the answer is the risk element which will be higher for this particular bond will be actually your principal default risk. Okay. Why? Because in 2 years we are going to mature this particular bond, and in 2 years there is not going to be tremendous interest rate fluctuations. So this bond is more exposed towards what? It is more exposed towards your principal default risk. Okay. But on the contrary, if I keep a 20-year bond in front of, so this particular bond will be more subject to interest rate risk. Why? Because there is going to be too many fluctuations in this particular bonds. So in the price of the bond, because in interest rates over the period of 20 years can be so much fluctuating. So that's why the price of the bond will also be so much fluctuating. So when you are going to be a long-term investor in these kind of bonds, so you are exposed more towards interest rate risk, right? So this price of the bond, which is also determined. Now, suppose the price of a bond for 2-year bond, okay, will have, if suppose the price is 100 rupees, example, okay, the price of the bond turns out to be 100 rupees. So in this 100 rupees, now in this interest and principal, see, because price of the bond is actually formed by taking what? It is formed by taking interest into PVAF, right? Plus your redemption value into PV factor, right? So this is how the price of the bond is determined. Do you all agree with this? Interest into PVF plus redemption into PV factor. That is how the price of the bond is determined. Now, my dear students, if I tell you something like this, that when talking about a 2-year bond, if interest and principal, these are the two components, which component will be more in this 100 rupees? So that in this 100 rupees, the component of principal is going to be, okay, interest component will be low. And when I'm talking about a 20-year bond, suppose its price is 100 rupees, it will also have interest and principal, that is redemption amount. Okay. Now, which component will be more in this 100 rupees? Then the interest component will be more. So slight change in the interest rates will have more impact on this present value of the interest. Okay. So this is something which you have to understand, my dear students, whenever we are talking about your, interest and your principal part, always remember that a bond with a higher duration will obviously be more exposed towards interest rate risk as compared to the bond with a lower duration. Okay. So come to this question number 67. Consider the two bonds, one with 5 years to maturity and another with 20 years to maturity. Both the bonds have face value of 1000 each, and the coupon interest rate is 8% with annual payments, and both are selling at par. My very first question to you is, there is one bond which is maturing in 5 years. There is another bond which is maturing in 20 years. Of course, the bond which is maturing in 5 years will have more principal default risk as compared to the bonds which is 20 years, which will be more exposed towards your interest rate risk. Okay. Both the bonds have a face value of 1000 and a coupon rate of 8% with annual interest payments, and both are actually selling at par. Okay. So actually the actual B0 is also nothing but 1000 rupees. Assume that the yields of both the bonds falls to 6%. Okay. So when the yield is going to fall to 6%, of course, the price of the bond will be affected. Okay. What will happen to the price of the bond? The price of the bond will rise. Come on, yes or no? Yes, sir. What percentage of increase or decrease comes from present value of principal payment, and what is the percentage increase decrease which comes from the interest payment? Okay. So this is going to be a very lengthy question. So that's why I'm just referring to this particular solution. See, for bonds A and B, I've termed it as A and B. These are the credentials of the bond. Okay. What is the actual price of the bond? Can you see the actual price of the bond is 1000 rupees, and the component of interest is 319.42 and the component of principal is 680.6. This is something which is going to happen for your bond A. Can you just check for bond A, your interest component is 319.42 and the principal component is 680.6. So your principal component is higher as compared to your interest component. Okay. So bond A is more exposed towards the principal default risk. Okay. Bond B, which has more duration, will definitely have more interest component. Okay. Can you see 785.45? So that 1000 rupees comprises of 785.45 interest and 214 of principal. Here this 1000 rupees comprises of only 319 of interest and more of principal. Okay. Now bond A is exposed towards principal default risk and bond B is exposed towards interest default risk. If the yield falls to 6%, then can I say bond price will increase? Yes or no? Yes, sir. And as you all can see, interest into PVF at the rate of 6% for 5 years and redemption values on this basis, you are going to get 1084.29 and this is 1229.39. So the price of the bond will increase accordingly. And as you all can see, that bond B has more impact in its price. Can you all see bonds B price has increased to 1229 and bond A has increased just to 1084.29. So both the bonds presently traded at 1000 rupees, but just slight change in the interest rate. Can you see the rise in the price of the bond B? It has from 1000 rupees jumped to 1229.39, but bond A it has just increased to 1084.36. Both have increased, but Bond B has increased by a higher percentage. Why? Because there was more component of interest rate involved in that. Okay. So then they have asked you what is the percentage change in increase and decrease. So from 1084 to 1084.29, that is increase. So what is the component of interest and what is the component of principal? So we have to see that interest component has increased by 17.57 rupees and principal component has increased by 66.72. Simply this can be done by comparison. See, your interest component is 336 and earlier your interest component was how much? It was 319.42. So the difference between the two was 17.57. Complete detailed analysis. So from 84.29, if 17.57 was due to interest, then of course 66.72 is going to be due to your principal part. So 20.84 and 79.16. Is this going to be your breakup common? Yes or no? Yes, sir. Similarly, for bond B, as you guys can just check from 12 to 9.31 from 1000 rupees, here the interest component is more. It's 57.6% as compared to your principal component. Okay. So this was the bifurcation part. But here we are also required to calculate what is going to be the duration. Okay. For a bond which is 1000 rupees, 6 years to maturity, 7% coupon rate. So what is going to be the bond's duration? So this bond's duration, my dear students, can be calculated by using the product method as we have discussed. And based on this product method, this comes as 5099.98 and this is 1000 rupees. So this is 5.1 year. Okay. Also at the same time, calculation of the price of the bond, if YTM increases uh, to 10%. So now when the YTM increases, the price of the bond is going to fall. So if I have the duration available, the first thing I should do is I have to calculate what is going to be my modified duration. So once I've got the modified duration, see, because in the third part they have told you if the YTM increases to 10%, how will it affect the bond duration and why? So first we'll calculate the modified duration. So the modified duration which we have calculated, that comes as 4.766. Okay. Now, if the yield increases by 3%, then the price of the bond will fall by 4.766%. Okay. 1% change in yield will result in 4.76% change in the price of the bond. So for 3%, it should be how much? So based on this, we can also calculate the revised bond duration, which is coming, revised bond price, which is coming as 857.02. So there is no need to again do the calculations. Simply part from 1000 rupees, you subtract 14.298, ultimately we'll be getting 857.02. So that's how your revised duration, your revised, whatever is your uh, bonds duration, first you have to calculate that, then based on that we calculate the modified duration, and once we have got the modified duration, then we need to check by how much percentage the bond price is going to be affected. So 1% increase can lead to 4.766. So for 3% it should be how much? You can cross multiply it and based on that we'll be getting 14.298%. So then the bond price can be reduced from 1000 rupees. So this is the revised bond price from 1000 rupees to 857.02. Okay. Now, let us solve one more, let us revise one more question for your bond duration, which is going to be your question number 68. Let's do question number 60. Okay, first, okay, let's do 60, 64. Okay, 64, because 64 has, uh, this concept of semi-annual basis. Okay, so let's revise this question. So for bonds duration, I'll be doing two questions. One we have done it, one will be on this question number 64. See what is given to you. Excel SPAT has made an issue of 14% non-convertible debentures, okay, on January 1, 2007, and these debentures have a face value of rupees 100 each, and currently which is traded in the market for rupees 90. Interest on these NCDs will be paid through post-dated checks dated 30th of June and 30th of December. Interest payments for the first 3 years will be paid in advance through the PDCs, while the last 2 years, your post-dated checks will be issued at the third year. The bond is redeemable at par on 31st of December and at the end of the 5 years. We are required to calculate the current yield and the YTM of the bond. So what are the bond credentials, my dear students? So it's a 14% NCD, okay? And as you guys can just check here, it's a 14% NCD, but because it's semi-annual, so that's why it's going to be for 7%. Redemption value is 100 rupees. Life of the bond is 5 years, which will ultimately give you 10 terms, and the actual B0 is 90 rupees. Now, my dear students, they have told you that interest will be given on post-dated checks, okay? But it will be paid in advance through post-dated checks. Now, this absolutely makes no sense. This is just like telling you that we will give you 2 years articleship stipend in advance. We'll give you 2 years articleship stipend in advance, but via post-dated check. How is this even making sense? So here the company is giving actually the interest in advance, but via post-dated check. So it's not called as an advance. Okay, this is actually the interest will be due as and when it will be received only. So there is no post-dated check here. But there is no advance payment which is being received here. Okay. So based on this, my dear students, how this particular interest will be received. So interest will be received now for the first 3 years, but it is on semi-annual basis. Okay, so first of all, you have to understand that this is going to be 10 terms. So for 5 years, it's going to be 10 terms. For 14%, it will become 7%. 7%. And also at the same time, we are required to calculate the YTM of the bond. So this is how first we'll be presenting the solution for current yield. It is nothing but interest upon actual B0. So 7 is the interest on half yearly basis. 90 is your actual B0. Based on that, we calculated. We get 7.78%. And if we multiply it by 2, again, we'll be getting 15.56%. And for YTM, we'll be using this formula YTM approx because redemption is happening only once. There is no need to prepare any table. We can simply calculate your YTM approx by taking interest plus RV minus purchase price upon N, the whole upon RV plus purchase price upon 2 into 100. So this will now give me YTM, which is 16.84%. Okay. How will I calculate duration of the bond? So I'll be taking year 1, 2, 3, 4, 5, 6, 7, and 9, 10. So this is going to be the tenure. We have the interest available. And let us take your discounting factor. Now see, whenever we are calculating the duration, we have to discount all the future value of the cash flows at your yield to maturity. So we have our YTM available as 8.42. So we'll be simply taking this interest and then we'll be discounting it at 8.42%. We'll be getting the present values. And once we get the present value available, guys, what we need to do is use product method for the purpose of duration. So we'll take present value, multiply that by years, we'll be getting the product. And that product will be dividing it by the actual B0 and ultimately we'll be getting the duration of the bond, which is 7.38. But since we have every time multiplied by 2, here we have to divide by 2 to get the duration. So the duration for this comes as 3.69 years. Then in the third part of the question, what have they asked you? That assuming that the intermediate coupon payments are not available for the reinvestment, calculate the realized yield. Now, if we don't reinvest it, can you recollect if we don't reinvest it, then what is going to be the consequence of that? Can I say that your cash flows are going to be the same? So then we find out the final total amount, which comes as 170. Then we have to use that compound interest formula. Amount is equal to principal into 1 plus I raised to the power n. Because your reinvestment is 0, right? So I had explained you that earlier. When the reinvestment is 0, what we are going to receive is simply the total of the coupons plus the redemption values. That is eventually going to give you the amount. So the amount turns out to be 170. Principal is 90. So then what is going to be your final rate? So that rate you can calculate it like this. But when you know that if suppose the rate is at the power 10. So if it's a dirty power, then how do you calculate that root of 10th in your calci? So these are the steps. So we have to take 1.889, then press root 12 times minus 1, divide by 10, and then, my dear students, plus 1, and then multiply is equal to 12. So then you'll be getting the final answer, which comes as 6.57%. If I multiply that by 2, it comes as 13.14%. So this is how we calculate realized yield when the reinvestment is not to be done. Okay. So this is the solution. So this is how, my dear students, we do our revision completion for your duration and modified duration. And I explained you one very important concept here. Okay, which concept did I explain you? That how does this reinvestment, for duration, if suppose we want to calculate the price of the bond, then first we need to check whether if it's a 5-year bond or a 20-year bond. And the most important part, I taught you that for a 5-year bond, it is more prone to principal default risk. For a 10-year, 20-year bond, it is more prone to the interest rate risk. Okay. I'll do one more question because, I cannot resist. I cannot, do further revision without this particular question. So I'm trying to, do maximum number of things in the most minimum time. I hope if you like this particular video, then do share it with your friends. Like the video, comment on it. May maximum number of people take advantage of this particular part. Okay. So if you just refer to this revision series videos, I hope you are understanding that I'm covering maximum number of questions. Everything which is having a different concept, we are doing. So rather than just solving 3 or 4 questions of, from the entire chapter, it's better that we cover maximum times. Okay, maximum number of things. So if you have done my regular batch, you will find this revision very, very, very effective. Okay, because now you just have to simply see the question, see the solution, what I've done in the regular batch, revise it very proper. Okay, but for those also who have done it from the other coachings, this revision is going to be helpful only because there everywhere you have studied all these things. So this revision can really help you to just brush up all your concepts, get some value addition to your concepts. Okay, some concepts if you have not studied earlier, then this revision can help you to, grasp all those things. Okay, and it can really be very effective for you. Okay, so let's do, even if it takes time, it's fine. Let's do this question number 69. This actually concept is regarding your portfolio churning. Okay, it's your portfolio rebalancing it. Okay, churning of portfolio. So what are we going to do in this particular question? The investment portfolio of a bank is as follows. So we have your government bonds available, which is 2006, 10, 15, 22, and 32, and we have the coupon rates, we have the purchase rates, and then we have the duration, which is 3.5, 6.5, 7.5, 8.75, 30. So now, my dear students, face value of the total investment is 5 crores in each government bond. We are required to calculate the actual investment in the portfolio. So how will you calculate the actual investment of the portfolio? We'll simply take this purchase price and we are going to multiply that by what is the total investments which you are making. So that will help you to calculate what is going to be the total investment in the portfolio. See, for every type of a bond, we are investing 5 crores face value. Now, if the purchase price is 106.5, what's the total investment then? So you can take 5 crores, divide that by 100. So 5 crores, if you divide that by 100, you will come to know that you have purchased 5 lakh bonds. Simply take this 5 lakh bonds and multiply that by 106.5. So then 5 crore 32 lakh 50,000. Can I say that will be your investment in GUI 2006 bonds? Again, for 2010 bonds, we have purchased 5 crore face value. Divide that by 100. So we have purchased total 5 lakh bonds. 5 lakh number of bonds, you multiply that by 105. Will you be getting the total investments on yes or no? Yes, sir. So that's how we'll be getting the actual investments of the bond. Okay. So my dear students, we have the total investments of the bonds like this. So we have actual investments of the bonds like this: 5.325 crores, 5.25, 5.25, 5.5 crores, 5.05 crores. That's how the total investment of the bonds becomes 26.375 crores. Now, what are the weights of the bonds? So the weights of the bond is 0.2. Because see, actual investments we have already got it 26.375. They have told you that uh, calculate the actual investments. What is the suitable action which needs to be taken if the interest rates are expected to be lower, if interest rates are expected to be higher, and calculate the revised duration. So first we'll calculate your original duration of the bond. So your original duration of the bond of the entire portfolio will be calculated by taking weighted average duration. So whatever is the duration for each and every bond which you have, if I multiply that by weights, okay, and sum it up, will I be getting the weighted average duration? Come on, yes or no? Yes, sir. So my weighted average duration comes out to be 7.81 years. So once I've got the weighted average duration, which is 7.81 years, then what I need to do is I need to check that if the interest rates are expected to be lower by 25 basis points, then how can I churn the portfolio investment? Now, what do I mean by churning the portfolio investments? So if I churning the portfolio investments, I have to sell one bond and I have to invest in another bond. Now, if interest rates are expected to be lower, then can I say the price of the bonds will be higher, right? Interest rate will be lower, the price of the bond will be higher. What should I do? Should I sell the bonds of higher duration or should I sell the bonds of lower duration? Now see, if the interest rates are expected to be lower, the price of bond will rise. Which bond? Which bond is going to have the maximum impact? Can I say the bonds which is going to have the maximum maturity? Those particular bonds is going to have the maximum impact. Come on, yes or no? Yes, the bonds with the highest duration, that is going to have the maximum impact, because you have just now seen that in a particular bond where the duration is higher, can I say that the proportion or the impact of the interest is higher? So when the interest rates are going to fall, the bond prices are going to rise, and the bond with the maximum duration, those particular bond is going to have the maximum impact, right? So in that particular case, can I say that GUI 2032, that particular bond is going to have the maximum increase in the price? So how should you churn your portfolio? So we will actually sell the portfolio bond with the lowest duration and invest that money in the bond with the highest duration. Okay, so that's called as portfolio churning. So what are you going to do? In this particular case, we will be, if the interest rates are going to fall, we sell the bonds with lower duration and we invest in the bonds with a higher duration. So we need to sell your 2006 bonds and invest in 2032 bonds. So that's how you'll be getting sell this particular bonds and buy this bond. So what will be your revised duration? So of course, now if you are investing more money in the bonds in which the duration is going to be higher, of course your portfolio duration is also going to be increased. So your portfolio duration now becomes how much? 9.075 years. Okay. So duration has increased from 7.81 years to 9.71 years. So lowest duration, sell it and invest in the highest duration. Okay. Now you must be having a doubt, sir. What about the other bonds? We can sell that as well. Yes, but Institute Chase will take two extreme cases. Okay. So lowest to highest. And when the interests are expected to rise, so bond price are going to fall. So which bond price will fall maximum? The bond in which the duration is maximum. So now what we'll do is we will sell that particular bond and invest the money where we will invest the money in the bond with the lowest duration. So that will give you the maximum impact. Okay, so that is something which we are going to do it. So here, as you guys can just check, we have invested, we sell 2032 bonds and invest in 2006 bonds. So because of which, the revised duration come as 6 years. So the bond duration has now fallen from 7.11 to 6 years. Okay. So this was a question on portfolio churning with duration. Okay. So let's continue further. Now we will do bonds refunding. Bonds refunding, we can just do one of the question. It's actually very simple. Bonds refunding actually deals with your what? We will be taking into consideration in your bonds duration, in your bonds refunding, uh, whether we should as a company, whether we should refund the bonds or not. Okay. So now this is something which you have to pay attention to. Okay. So just listen to me very carefully. Uh, let's say, for example, I'm the CFO of the company. Okay. I have issued you the bonds. Okay. Which was supposed to be, let's say, matured after 10 years. And I have kept one right to call option. Now, what is right to call option, beta? In right to call option, does the company have a right to call for the bonds after some number of years? Come on, yes or no? Yes, sir. So it is possible that the company can call for the bond. So what will the company do? Company will tell, okay, listen, boss. After the end of 5 years, if we want that, we can call for the bonds and this is the call price. When will the company exercise the call option? The company will only exercise the call option when they think that in the market the interest rates have fallen. So company, whenever there is bond refunding question, you will always see callable bonds in the question. So in callable bonds, what happens is that the company is going to issue the bonds, which is supposed to be redeemed after 10 years, but company will have an option to call for the bond at the end of the 5 years. So in callable bonds, we are going to call for the bonds before its maturity. Suppose my coupon rate is, let's say, for example, 10%. But after the end of 5 years, the market yield has now fallen to 6%. So I can raise more bonds at the rate of 6%. So why should I pay 10% coupon when I am going to get the new funds at the rate of 6%? So here in this particular case, we are going to be involved in NPV decision. We are going to be involved in what? NPV decision. And in NPV decision, if the present value is positive, then we will go for your bond refunding. If the present value is negative, then we'll not go for bond refunding. Okay. So in bond refunding, basically, you'll always see callable bonds. Company will always exercise the call option when the market interest rates have fallen after some number of years. Number three, the company will issue the new bonds at the lower interest rate and take that money and with that money refund the old bond. So that is called as bond retirement as well. Okay. And we are going to use NPV decision. If NPV is positive, bond refunding needs to be taken. Okay. Now, in this particular case, let's solve one question. Let's just revise this particular question on bond refunding. Let me see if I have it here or not. Okay. So we have your question number 70 and 71. We'll do question number 70. Okay. Now in this question number 70, let us first read the question. What is available? ABC has 300 million, 12% bonds outstanding with 6 years remaining to maturity. Okay, so there are 6 years which are remaining. So we can also write down the credential of your old bonds. Okay, so there is 300 million. Okay, and 6 years are remaining, and we have the coupon rate of 12% here. Okay, so we have a coupon rate of 12%. After that, if you continue, Since interest rates are falling, ABC is contemplating of refunding these bonds of 300 million of 6 years carrying a coupon rate 10%. Okay. So now we are going to issue a new bonds at 10% rate. So here, as you all can see, there is 10% rate again 6 years and the total is 300 million. And then continuing further, it is mentioned that issue cost of the new bond will be 6 million. Okay, so this is going to be your issue cost, which is 6 million. And the call premium is 4%. So this will be your call premium 4%. So if I'm calling for the bond, I don't have to pay 300 million. I will have to pay 4% more. So I have to pay 312. Okay. Then we also have your rupees 9 million as unamortized portion of the bond of the issue cost of the old bonds, which can be written off no sooner than the old bonds are to be called off. Okay. So my dear students, we have this call premium of 4 million and 9 million is your unamortized portion. So call premium is 4 million. That is something which we have 4%, which we have taken into consideration as 12 million, and the unamortized portion. Now, what is this unamortized portion of the old bonds? See, I just wanted to pay attention. When I had issued the old bonds, these old bonds I had actually issued at what? These old bonds I had issued at 300 million, and there would have been some issue cost and there would have been some discount as well. But let's say, for example, there was issue cost. Now, does this issue cost be debited in the P&L account in the very first year? Then the answer is no. So we have to amortize it over the number of years. So now there is some unamortized portion of this issue cost which is lying in my balance sheet asset side. Now this unamortized portion, can I say, have to be debited in the P&L account and it has to be written off. But if the old bond is going to be retired, what will I do with this unamortized portion? Then this unamortized portion will be debited in the P&L account. Okay, so we have this 9 million of unamortized portion. If I'm retiring my old bonds, if old bonds is only not into existence, then what will I do with this unamortized portion? Can I say I will debit in the P&L account? Come on, yes or no? Yes. So this unamortized portion I'm going to debit in the P&L account. Okay. Now continuing further, marginal tax rate is 30%. You are required to analyze. See, always remember that whenever you are doing question on bond refunding, all the types of expenses is allowed as a deduction which is eligible for tax savings. So call premium, will it be eligible for tax savings? Yes or no? Yes. Unamortized portion, when it will be debited in the P&L account, will it be eligible for tax savings? Yes or no? Yes, sir. Okay. Now, for NPV, we have to first check what is the PV of CO, what is the PV of CI, and we need the discounting factor. So in this question, the discounting factor was not given to you. But we know that in the market right now, the coupon rate which is going on is 10%. So 10% is the coupon rate, but cost of capital is always post-tax. So that is why we take this 10%, multiply that by 1 minus tax rate, we'll be getting the post-tax, which is nothing but 7%. So is my 7% to be treated as post-tax cost of capital? Come on, yes or no? Yes, sir. Will this be used for discounting from future value to present value? Yes or no? Yes, sir. Okay. So now, my dear students, at DA0, let us see what is the present value of cash outflows which are possible. Are we refunding the old bonds? Come on, yes or no? Yes, sir. What is going to be your outflow? Your outflow will be 300 million plus 4%. 312 million, this is going to be your outflow. Okay, so this is your money going out. We are issuing new bonds and we are issuing new bonds at, there is some discount or what is it? Or there is some issue cost. No, issue cost will be 6 million. Okay. So in that particular case, can I say in my hand, I'm just going to receive 294. Okay. Now, 312 million, that's my cash outflow. But I've received 294 million from my new bonds. Okay. So this is something which I'm going to subtract. But also at the same time, you have to understand that if the old bond is going to retire, will I get the tax savings on the old bonds? Come on, yes or no? Yes, sir. I'll be definitely getting some tax savings on the same. So in this particular case, call premium, because you know that this particular old bonds will be called at a premium of 12 million. This 12 million, when debited in the P&L account, will it result in tax savings? Yes or no? Yes, sir. And these savings is nothing but one type of cash inflow. So I'm going to subtract it. So that's why 12 million was the call premium, unamortized portion of the issue cost, because as I told you, old bond is going away. So its unamortized part will be debited in the P&L account today. Will it result in any kind of tax savings? Yes, sir. So that's how the total tax savings will be 21 million into 30%, that is 6.3. So I subtract that, I'll be eventually getting 11.7, and 11.7 I'm going to incur today itself. So that's why 11.7 million is my cash outflow. What is my cash inflows? the entire activity is done for what? Savings. So any savings in your capital budgeting is to be treated as your cash inflows. So we have this savings of 2% on 300 million. So 6 million is the savings. But whenever we save money, we have to pay tax also on that. So tax paid is subtracted as outflow avoided is an inflow. And on that inflow, we have to pay tax on it. So that's why on that we'll be paying 1.8. So that's how 4.2 million will be treated as your tax paid. Okay. Now, in this particular case, what is going to be now tax paid on the savings due to flotation cost? Now, see something which you have to understand here. In old bonds, if the old bonds would have been continued, then those unamortized expenses would have been debited in the P&L account, right? Yes or no? Yes, sir. What was your unamortized expense? Your unamortized expense was 9 million divided by 6. So that is how, because 6 years it would have been taken for the purpose of amortization, right? Because if old bond would have been continued. So 9 divided by 6 in the P&L account, 1.5 would have been debited. But for the new bonds, just check what is going to be your unamortized part. See, as you guys can just check, we have in this particular case 6 million as the issue cost. So this 6 million will be written off over the period of 6 years. So in that particular case, 1 million will be debited in the P&L account. Now, if old bonds would have been continued, 1.5 would have been debited in the P&L account. If new bonds are continued, 1 million is debited in the P&L account. Don't you think that now there is a savings of 0.5? And if there is a savings of 0.5, you will end up paying tax on it. Simple. So if old bonds would have been continued, 1.5 would have been debited. If new bonds are continued, then 1 is debited. Then it will result in some kind of your savings. Your profits will be relatively higher. You'll end up paying tax. So that is why you'll end up paying tax of 0.15. So from 4.2, if I subtract 0.15, then 4.05, that will be treated as your PV of CI. For that, I will multiply that by the annuity factor. So this was your cash inflow per annum. If I multiply that by the annuity factor, we'll be getting 19.304. This 19.3, if I subtract that by PV of CU, I'll be getting NPV positive 7.6. Will I go for the bond refunding decision? Yes or no? Yes, sir. So always and always remember this fact that whenever we are going to deal with your bond refunding, you have to pay attention to what is going to be your cash outflows and cash inflows. So your cash outflows will be what? We are going to repay the money, but we are also going to get some money. So the difference part is going to be your cash outflow. Then you have to see if old bonds are going. So whatever is the unamortized part will be debiting in the P&L account today itself. So will that result in your tax savings? Yes or no? Yes, sir. Then once that is done, the second part, PV of CI, we need to check how much is the savings which is happening. On that savings, pay the tax also. So we'll be getting post-tax savings. And then if old bond would have been continued, so we'll be debiting those expenses, unamortized part. If there is any issue of debenture, issue cost or discount charges, that would have been continued over the number of years. So how much amount would have been debited? But if the new bonds is taken into consideration, then new bonds, how much amount will be debited? Okay, if your old bonds, the debit was higher in the P&L account as compared to the new bonds, because in old bonds, example, issue cost was higher, then discount was higher. So because of that, what happened? That in the profit and loss account, your profits would have been relatively lower. But because of the new bonds, issue cost is relatively lower. So your profits are higher. So you end up having higher profits in your books. So in that particular case, we'll be paying tax. So whatever tax paid, that will be subtracted. And then we'll be getting the final net savings on per annum basis, which will multiply that by the annuity factor to get the PV of CI. From that, if we subtract the PV of CI, we get the NPV. NPV is positive, we can accept it. Okay, so this question, if you want, you can solve it right now also by pausing the video, because this question of bond refunding covers everything. Okay. Next, let us start with immunization of the bond portfolio. Now, immunization of bond portfolio is something which I have done it in extreme detail. There is one video which you can see it in our CA Final AFM Hindi English, where the entire immunization of bond portfolio is explained with all the questions, but still I will revise it for you. Okay. So if you want to understand this concept in too much of detail, what you can do is you can just refer to those videos which are there for immunization of bonds. But if you want to just revise it now, what is this bond immunization? Okay, we will be doing one question of this as well. So let me first explain to you what is your bond immunization. See, Basically, let's say for example, okay, you want to, you're a CFO of a company, okay, and let's say for example, you have some commitments after 5 years period of time, okay. Suppose at the end of the fifth year, suppose at the end of the fifth year, you actually have to pay 1 crore to someone, okay. Can I say that this is nothing but the future value? 1 crore is nothing but the future value which you have to pay at the end of the fifth year. So you are telling me, sir, let me invest it today itself in such a way, whatever happens at the end of the fifth year, I'll be getting 1 crore. I'm like, okay, fine. What do you want to do? You're like, sir, I'll go to the bond market. And in the bond market, I will invest in the bonds. Now, my question to you is, if you create a portfolio of multiple bonds, okay, but what if tomorrow the interest rate rises, then the price of the bond will fall. So then you had planned it in such a way that at the end of the fifth year, you are going to get 1 crore. You calculated the present value of that 1 crore today and made the investment today itself at its present value in multiple bonds. But if suppose I tell you that after some number of years, after some number of, let's say the moment you invest, after that only the interest rate in the market increases, the price of the bond will fall. So then automatically your bond portfolio will have reduced value. So how will you meet your commitment of 1 crore then? Then it's not possible, right? So your 1 crore commitment will not be possible if suppose you are going to, take this into consideration. You are going to take your yield into consideration like this. So that's not going to be possible. Okay. So now what is the next step? What you should do? So you should create a portfolio in such a way that it remains unaffected by whatever is the yield which is going on in the market. Okay, whatever is the changes in the market yield, your bond portfolio is not going to be affected by the same. You are going to get your 1 crore for sure. Okay. So bond, in the concept of bond immunization, what you do is you first calculate what is the present value, okay, as per the current yield. Suppose the current yield which is going on is 8%. So from 1 crore, you discount it, you bring it to the present value, you get the present value, how much amount is to be invested right now. Then decide what is the bond portfolio duration. Okay. Suppose the portfolio duration is example 5 years, Then select two or more bonds in which one bond should have a duration which is less than the portfolio duration, and one bond should have a duration which should be more than the portfolio duration. Okay, simple concept. So what you should do, first of all, you should check what is the portfolio duration. Suppose your portfolio duration is 6 years. Okay, so it means that suppose you need the money at the end of the sixth year. Then what you should do? You should first search for the bonds in which one bond duration should be less than 6 years and one bond duration should be greater than the 6 years. Okay, so that's how first you have to figure it out. Okay, what we need to do. Now, let's say for example, in the market, there are zero coupon bonds. So for zero coupon bonds, whatever is the YTM, that itself, whatever is the duration, that itself is your maturity years. Okay, but only thing is for coupon bearing bonds, you have to understand that the duration is actually be lower than whatever is the maturity. Okay, only for coupon bearing bonds. But for zero coupon bonds, as you all know, that your duration will be equal to your whatever is going to be your maturity. So now first let me do question number 73. Okay, now see, in this question number 73, okay, in this question number 73, first let us read. A company has to pay rupees 10 million after 6 years from today. So basically, we know that apparently what is going to be the maturity. The maturity is going to be at the end of the sixth year. You actually want 1 crore rupees. The company wants to fund this obligation today itself, and the current interest rate in the market is 8%. So what we need to do is, first of all, we need to calculate the present value. So the present value turns out to be 63 lakh 1,696. So this is the present value. So you have to invest today 63 lakh 1,696. Now let us see what is given to you. Two zero coupon bonds are traded in the market on the base of 8% YTM, one with 5-year maturity and another with 7-year maturity. So your portfolio duration is 6 years. Are you seeing that you have to select the bonds? One with a maturity of 5 years and another with a maturity of 7 years. So we actually have one with a 5-year maturity, one with a 7-year maturity. So one with a maturity which is lower than the portfolio duration and one with a maturity which is higher than the portfolio duration. Okay, why do we do that is basically because when the interest rate changes now, so the bond which is going to mature at the end of the fifth year, listen to me very carefully. The bond which is going to mature at the end of the fifth year, that maturity proceeds will be reinvested at the change interest rate, and the bond which will be matured at the end of the seventh year, if suppose at the end of the sixth year, let's say for example you want to sell this particular bonds, so then whatever is the changes in the market interest rates, based on that the yield will also be having an effect. Okay, and the bond prices will change accordingly. So based on that you will be getting your revised bond price, so you can sell it at revised bond price as well. Okay, so you are not going to get the maturity at the revised bond price. So based on this we are required to see that what is going to be your uh, market interest rates, and what will be the impact on the bond portfolio. Okay, so see, we have to calculate what is going to be the immunized investment plan. Now let's continue this further. Okay, first of all, we know that there are two bonds. We have zero coupon bond A, we have zero coupon bond B, one with a life of 5 years, one with a life of 7 years. So we don't have the actual price of the bond, but it's very easy to calculate what's going to be the actual price of the bond. Whatever is the redemption value, will discount it, will bring it to the present value. So this will give you 68.06, and this actually gives you 58.35. So uh, we have this as your zero coupon bond actual market. So now continuing further, we know that the price of the bond is 68.06, and now this is 58.35. So these are the two prices of the bond, and this is the price of the bond at which it is traded in the market. So now, first of all, we have to understand what is the proportion. How are we going to make the investments in the bond? See, first we know that the bond is, we have to first of all need 1 crore rupees at the end of sixth year, for which we have identified there are two bonds. One bond which is going to be matured at the end of the fifth year, and another bond is going to mature at the end of the seventh year. Okay, so we have determined what is the prices of the bond. But first of all, we should know now at what proportion we are going to invest in this particular bonds. So that proportion we have to calculate it with the help of this table. So where we have taken duration of bond is 5 years, duration of bond B is 7 years. Let the weights be X. So this bond B weights will be 1 minus X. So based on that, we have the weighted average duration of 6 years. So now we have bond A 50%, bond B 50%. Okay. So 63 lakh 1,696. If I have got the duration, so if I've got the weights of bond A is X and the weights of bond B is 1 minus X. So based on that, we got 50-50%. So now I know that how much needs to be invested in bond A and how much needs to be invested in bond B. So if I have the market price of the bond available, don't you think on the basis of that I can get what are the number of bonds? So number of the bonds is 46,295. Now this is, for this I've taken the face value of the bond as 100 rupees. If you want, you can take the face value of the bond of 1,000 rupees as well. Okay. So based on this, I have got 46,295 bonds and 54,000 bonds which needs to be invested. Okay. Now in situation one, when the interest rate of the bond continues to be 8%, okay, then in that particular case, can I say I'm going to get my 1 crore rupees anyhow? Come on, yes or no? Yes, let's prove it. So we have 46,295 bonds A, which will mature at the end of fifth year for 100 rupees. So this is the maturity proceeds, but I need the money at the end of the sixth year. So what am I going to do? I'm going to reinvest this for the period of 1 more year. So the moment I reinvest it, I'll be getting 49,99,860. So this is going to be my total amount of ZCBA from that which I'm going to get it. And from ZCBB, we are going to sell it at the end of the sixth year. Now here's something which you have to pay attention. Bond had a maturity of 7 years, but we are going to sell this particular bond at the end of the sixth year. So we need the market price at the end of the sixth year. Now when the yield in the market which is going on, that is nothing but 8%. So what should be the price of the bond at the end of the sixth year? So if something which will be redeemed at the end of the seventh year, and you are going to get 100 rupees, so what should be the present value at the end of the sixth year? So at 8% discounting factor, the present value comes out to be 92.59. So simply we will take 100 into 1 divided by 1 point discounting factor, we'll be getting 92.59. So now this 54,000 bonds will be selling it at 92.59, because 92.59 at 8% will give you 100 rupees. Okay, so bond which was traded at 100 rupees I had a redemption value of 100 rupees. At the end of the 6th year, at 8% yield, it will be traded at what price? So it will be traded at 92.59. So we have the number of bonds, we multiply it, we'll be getting 50 lakh rupees. So 50 lakhs, both the things needs to be taken into consideration. So that's how 1 crore rupees will be getting. Okay. Now, if the yield turns out to be 6%, so in this particular case, we'll be getting at the end of the 5th year, whatever is your 46 lakh 29,500, because zero coupon bond A will be maturing at the end of the 5th year. So the total proceeds which will be getting 46 lakh 29,500. What will you do with this total proceeds? So we are going to reinvest it. Reinvest it at what rate? Reinvest it at 6% rate. So we'll be getting 49 lakh 7,270. So this will be called as your total amount which you'll be receiving at the end of the 6th year from the ZCBA, which will be reinvested for 1 year. So you'll be getting 49 lakh 7,270. What about bond B? So bond B, we are going to sell it again at the end of the 6th year, but this time at a different price. Because here now the yield in the market is going on, that is 6%. So based on that, we will be now getting this as 94.34, because if something which will be maturing at the end of the 7th year for 100 rupees, what is its present value today at the end of the 6th year? Okay, at 6% yield. So based on that, we got this as 94.34, which I multiplied that by 54,000, I'll be getting 50 lakh 94,000. If I sum it up, then total I'll be getting 1 crore, roughly 1 crore itself. Also at the same time, when the yield changes out to be 10%, so then the reinvestment will happen at the rate of 10 lakh 92,450 from ZCBA. Again, ZCBB will be sold at the end of the 6th year. At what price? At the price at the end of the 6th year, which will be 90.94. So then whatever is your 54,000, you will 54,000 bonds, you will be multiplying that by 90.91 to eventually get what is going to be your 49 lakh 9,000. So total, can I say you will be getting 1 crore rupees? Come on, yes or no? Yes, sir, we'll be getting your 1 crore rupees based on this. So come what may, you are definitely going to get your 1 crore. So this entire concept of immunization, if you want to see that entire detailed video in which I've explained all these questions of immunization in much more detail. Okay. Now, continuing further, okay, we will be doing now your money market instruments. Your money market instruments, these are, relatively easy, okay, questions. Because in money market instruments, now we just have to calculate your normal calculation. Okay, let me do one more thing. Let me solve one more question on duration. Okay, where there are weights and all also possible, because see, duration and immunization all put together. So I have one classic question, which is a question number 74. Okay, this question actually has your duration as well as your immunization all put together. Okay, I just want you to revise this. Little bit video will take time, but it's going to be worth it. So question number 74, let me revise this question as well, because this actually has your duration as well as modified duration and also your immunization of portfolio. So all this put together. Okay, the following data available for the 3 bonds are given to you, and this is your coupon bearing bond. Okay, one question on immunization I did it for 0 coupon bonds. Now I'm doing it for your coupon bearing bonds. Okay, these bonds are used by a portfolio manager to fund an outflow which is scheduled in 6 years. Current yield is 9%, and all the bonds have a face value of 100, which will be redeemed at par. Interest is payable annually. We have bond A, B, C, we have maturity, we have coupon rate. We are required to calculate first part is what is the duration of the bond. So how will you calculate the duration of the bond? So we are going to take year 1 to year 10. Whatever is going to be your interest, we will discount it at your YTM. Your YTM in this particular case is 9%. So we will be now discounting it at 9%. We'll be getting present value. We'll use product method. So on this basis, we'll be getting the duration of 6.86 years. Similar to that, we also have to calculate the duration for bond B. Applying the same process, we'll be getting the duration, and for bond C. So we have now the 3 durations available. That was the solution to the first part. Then the bond portfolio manager has been asked to keep 45% of the portfolio money in bond A. Calculate how much is to be invested in bond B and C that needs to be purchased to immunize the portfolio. So basically, my dear students, we need the money after the end of 6 years. So basically, we know that the portfolio duration is going to be your 6 years. So when I know that my portfolio duration is going to be 6 years, I have 3 bonds in it. Okay, I'm investing 45% in bond A. Let the investment in bond B be X. So your investment in bond C will be total is 1. 1 minus 0.45 minus X. Okay. I have all the three durations available. So based on this, I'll be finding down what is going to be my X, and X turns out to be 0.36. So obviously your investment in bond C will turn out to be 19. So that's how we are going to invest A 45%, B 36%, and C is going to be 19%. So that's how we're going to bifurcate our investments. Then they have told you after the portfolio has been formulated, the interest rate change occurs, increasing the bond yield to 11%. And the new duration of the bond is 7.15, 6.03, and 4.27. Is the bond portfolio still immunized? So what we need to do is now, based on this three bonds duration, because the bond duration has been revised. Why the bond duration has been revised? Because there has been change in the interest rates. So now they want to check whether the portfolio is still immunized or not. So what we will do, we have already the weights available. We have the new duration available. Now we'll revise and we'll calculate what is going to be the revised portfolio duration. So your revised portfolio duration turns out to be 6.2 years, but actually you wanted the money at the end of the sixth year. So in this particular case, can I say that the bond portfolio is not immunized? Come on, yes or no? Yes, sir, it's not yet immunized. In the fourth part, they have asked you that how are we going to need to immunize the bond portfolio? Now, in this particular case, if suppose these are the revised durations, which is given to you in the second part, so what should be the proportion based on which your entire your portfolio will be immunized? So again, for 6 years, we have to calculate weights. So let we have 45% which is invested in A, that's given to you in the question. Let B be X. So 1 minus X minus 0.45. So on the base of this, we'll be getting your X and then we'll be substituting the values. So we got the new weights, which is 45% can be invested in A, in B 25% can be invested, and in C 30% can be invested. Okay. So this is how we have to solve it. Now let us start with this. Now immunization, I think, can be done very thoroughly. Okay. Now we'll be starting with money market instruments. So money market instruments have different types of investments available. It can deal with your commercial papers, corporate bonds, treasury bills, and here we are required to calculate what can be your investment tenure, or how can the yield be calculated, what will be your annualized yields, and all these things will be forming part here. Okay. So in money market instruments, now let's start with question number 76. RBI sold a 91-day treasury bill of face value of rupees 100 at a yield of 6%. What is the issue price? So we are required to calculate the issue price. So my dear students, the returns which is provided, that is 6. Okay. Redemption value is 100. So the formulas which we are using, normally the same formula we are using it. Redemption value minus issue price upon issue price into 100. But here we are investing it only for 91 days. So what will be your annualized yield? So for annualized yield, we'll multiply that by 365, divide that by 91. So based on this, let the issue price be X. So we have calculated the issue price, which comes out to be 98.52. So very simple concept, because what is your yield? Your yield is nothing but your redemption value minus purchase price upon purchase price into 100. That's what the formula for yield is. And if my investment is for the period of just 6 months, so what we'll do, we'll take 12, divide that by N. Okay, if it is for days, we'll take 365 divided by N. Now we need to calculate the issue price. So let that be X and we solve it. We get 98.52. Okay. Then my dear students, let us do another question, which will be question number 77. Wonderland has excess cash of 20 lakhs, which it wants to invest in short-term marketable securities. Expenses related to investment is 50,000. The securities invested will have an annual yield of 9%. The company seeks your advice as to the period of investment so as to earn the pre-tax income of 5%. Discuss. So basically now we want to earn a pre-tax income of 5% on our investment. So our investment is 20 lakhs. On that 5% is 1 lakh. But my dear students, to earn this particular 1 lakh, this is not sufficient because there are some issue expenses also. As you guys can just check, there is some investment expenditure also, which is 50,000. So we are appointing a broker, etc., something like that, and they are charging 50,000 for the purpose of making that investment. So if you want to earn net 1 lakh, that will not work. We have to earn 1 lakh 50,000 first, because 50,000 is for your expenses. So total we have to earn 1 lakh 50. So basically now, if an investment is going to yield 9%, then for how much period of time we should keep the money so that at least we can recover 1 lakh 50,000. So what's the simple interest formula? 20 lakh into 9% into n divided by 12. So based on that, we got that we should at least hold our investments for the period of 10 months so that at least we can get 1 lakh 50. From that, 50,000 is your expenses and 1 lakh rupees you can take it home. Then in the second part, They have told you if you just want to recover your investments of 50,000, then what should be your tenure? So from 20 lakhs, if you multiply by 9% into n divided by 12, so 1,80,000 into n divided by 12, we'll be getting the tenure that as 3.33 months. Okay, so this is something regarding the question number 27. Okay, now actually I want revise this particular question in your money market instruments, which refers to your first leg and second leg of payment. Okay, so basically in this particular question, question number 79, see, you have to understand one concept that, let's say for example, one bank wants funds from another bank. Okay, so one of the way how this particular funds can be acquired is with the help of taking loan from RBI, or let's say for example taking loan from another bank. So let's say for example, if I am HDFC Bank, I need money for 14 days. So I go to SBI and I tell SBI, listen, give me money for 14 days. Now SBI is not going to give me the money as it is. SBI will tell, chalo, what is the security what you have? So I am telling SBI, okay, there is a 10% government of India bond, which I have it with me. I will, let's say for example, take this as a, I'll keep this as a security. You give me the funds based on that, okay? And then I will repay it and you give me the securities, something like that, okay? So understand that bank A enters into a repo for a 14-day with bank B. So bank A wants loan. So that's why repo rate needs to be taken into consideration. But in 10% government of India 2008 bonds at 5.65% for 8 crores. So let's say for example, bank A has 8 crore 10% government of India bonds whose the maturity is going to be 2028 and the coupon provided is 5.65%. So bank A is telling, keep this as a security, give me the money for the period of 14 days. Assuming that the clean price, the price that does not have accrued interest is 99.42 and initial margin be 2% and the days of accrued interest is 262 days. What is the dirty price? So for the first part of the questions, we are required to calculate the dirty price of the bond. Now, why do I need to calculate dirty price is because if I am taking this bond and keeping that as a security and taking money, I will definitely take this particular bonds at its market price. So if you have purchased the gold, let's say for example for 30 lakhs, but right now the price is 35 lakhs. Now you want to keep this gold and take some loan. If you want to keep this gold as a security and take some loan, so obviously for that 35 lakh rupees, you will be for that 35 lakh rupees, you will be taking that revised gold value. You will not be taking 30 lakhs. So that's why we need the revised market price, that is dirty price of the bond. So what is the dirty price of the bond? Whatever is the clean price, we will add the accrued interest for it. So the bond is providing the interest rate of, as you can just check, 10%. Sorry, this bond is offering 2028 bond is offering the interest rate of 10%. Okay, so 10% is actually the coupon for this particular bond, which is kept as a security. 5.65% is nothing but the rate of interest at which bank A is going to take the loan from bank B. So that is why it's called as a repo rate. Okay. Now this 10% government of India bonds for accrued interest of 262 days, what will be the interest amount? Okay. So if you guys can just check this out here. So we have the interest amount which is appearing as 7.277, and based on this, the price of the bond will now become 106.7. So now what is going to happen now, that bond A will bank A will tell bank B, listen, I have 106.7 worth of one bond. Okay. Face value is 100 rupees. I need 8 crore rupees. How much amount can you give? So bank A will offer 8.536 crores to bank A. Okay. But here the here there is some initial expenses which is 2%. Okay. Have you first understood what is this? So if I need 8 crore rupees amount on 100 rupees, so for 106.7, how much amount will I totally require? I'll require 8.536 crores. Okay. But what is happening here is that there is 2% of initial margin. So I need to subtract 2% of it. So that is why this will be 8.365653 crores. Now on this, at the time of repayment, I have to give them along with interest. Okay. Because 2% was the margin. So I was anyway only getting 3653 crores. So I need to add interest element at the rate of 5.65% per annum for 14 days, which gives you 0.0183. So the total amount which I'm going to get it is 8.3836 crores. So that is the amount which needs to be repaid, and that's what they have asked you. What is the repayment at maturity? So bank A will repay to bank B this much amount. 8.3836 crores. And how did we get this? We first understood what is the amount of the loan which will be available with bank A. So this loan availability will be based on the revised market price of the bond, which will be a dirty price of the bond. And then we understood that this is the amount which we require it, and 2% will go away. Okay, on that the interest will be taken into consideration, and you'll be finally paying 8.3836 crores. Okay, so with this, my dear students, we are done with money market questions as well. And now the next chapter which we will be revising, that will be business valuation. Thank you so much everyone for listening to me. I hope you have understood this. I've gone a little bit fast for this particular chapter because the number of questions are more. So that's why I wanted to revise this in 3 parts. We have revised it. Now the next chapter which we'll be revising, I'll try to solve more number of problems. Okay, so that's it. You have understood. I hope you all have understood this. Bye. Take care. See you. Bye.